Be carrying positions into Monday, or do you want to lighten up? I think is a question people will be asking.
Bracing yourself for next week. I mean, our guest last hour was not worried about too much volatility around the BOJ. Thinks a lot of it's now price, which is a different story from a year ago.
But that's good for the BOJ because that means it can move without causing a kind of big market move. Are we going to get a big market move this morning? We're about to find out. European stocks are opening. We'll see which stocks move first thing. Shell's already providing some points upside. It's amazing. Look at this. So yesterday, Novo was the biggest points add to the stock 600. This morning, it is already the biggest points drop. So you are seeing that. So it kind of one day on, one day off seems to be the trade at the moment. Yesterday, we did see the commodity stocks under pressure. Shell is up this morning. Glencore is up this morning.
Basic Resources, best performing sector this morning.
There you go.
It's a reversal of yesterday.
This is, and so again, Bloomberg Intelligence putting out a really interesting piece of analysis on the fact that there's so much catch-up needed in terms of the big energy players in Europe, certainly waking up, at least investors waking up to the fact that, hang on a second, of course, these companies should be benefiting when oil prices are higher, and they've continued to grind higher. You had the outlook, of course, from the IEA. So, and they think that it's given the valuations around some of these big energy players in Europe, that there's still further to run on that.
I have many things to say on multiples. Exxon versus Shell, Exxon versus BP. The Europeans trade on a significant discount. I was talking to a fund manager the other day, portfolio manager, and he was saying, you look at the cash that gets kicked out by a stock like BP, the yield is absolutely sensational at the moment. Do you want to own that? If you're an income investor, that looks pretty good. Can it be sustained?
Yeah, something of a specialism for some of the UK market, isn't it? That the whole income trade. Your point about plateaus is worth lingering on, though, Tom. Perhaps that's where we are on the European stock story. I mean, not really moving anywhere in the aggregate today. And it's interesting that we're talking perhaps about rates plateauing. Well, I mean, they have been, haven't they, for months?
For a while.
Yeah, and then maybe they plateau for longer. Maybe that journey across the top of Table Mountain is longer than we thought it would be in a global context over in the Fed. Not talking about the Bank of England specifically, but maybe we plateau for a lot longer. And actually, maybe then the Fed and even the BOJ next week are not the events we should be looking for, but it should be the numbers out of NVIDIA, and it's back to talking about that growth story and whether AI can really deliver.
Well, that's interesting to see whether it's the central banks or the main tech story of the day, the main company of the day, NVIDIA, which drives the sentiment next week. But to what extent, I wonder, has this market priced in in terms of the dot plots, or if we do, I think that's a key question, isn't it? If we get the move from 3 to 2, is there a further reaction on the downside for exiting the markets, or is it largely priced in at this point?
As it was when we moved from 5 to 3, it was sort of quite smooth. Really.
It was amazingly smooth, surprisingly smooth, and stocks went up. You look at I don't know what would the 2-year look like in the States if we go to 2. Do we see a move back to 5%? We're not there yet. What are we, 30 bips off? So I don't know whether that would be a kind of psychological level that would take us, that would be a reason to pause. Yesterday was really interesting. It was the counterpoint between this strong PPI print, but this weak retail sales number. Which one do you focus on? Kind of where is the emphasis? Where should you place the emphasis? Is it on the fact that inflation is going to remain sticky, or is it the fact that actually maybe the consumers have had enough? Maybe that starts to erode that kind of consumer confidence, which has been such an important driver.
And that haunting question, at least, as to whether or not we're starting to see the edges, maybe, of stagflation in the US. I also wonder if there's a vulnerability around the small caps in the US as well on this higher rate environment for longer, the squeeze maybe when it comes to credit profiles. You've been talking, you flagged the fact that credit spreads have been quite narrow, but if that changes, the small caps, the pressure that comes through there, does that lead to more consolidation, more M&A activity in the US? There's some potential follow-throughs when it comes to the smaller listed companies in the US potentially.
Lots to talk about. We want to get into a conversation next with Bani Buwaja, strategist at UBS, who joins us. And Bani, very good morning to you. We want to get into some of the linked conversations to what Tom was just talking about there, because you've got some really interesting things about comparisons back to the 90s, where they're relevant, and crucially, where they're really not. But before we do that, wanted to get your thoughts on the BOJ. We've heard this morning these wage conversations in Japan have resulted in 30-year high wage deals in Japan. And then the assumption is that's enough. That's the last piece of the puzzle for the BOJ to finally pivot on rates for the first time, hiking in a tightening move since 2007. Are you looking to next week, the BOJ, as a source of volatility, or is it all priced in now, do you think?
It's getting largely priced in, right? And the market is expecting the March move now. And we think that there's a small possibility that they actually move in April, because they'll still wait for other negotiations for wages for smaller companies as well. So there'll be greater data in April. There'll also be the opportunity to explain things a little bit better in April, because they have the outlook report at the time. So April, we think, is still a possibility. The market is clearly putting in more probability on March. I don't think this move itself is going to be that consequential for global markets, because this is largely being priced in. But make no mistake, as the ECB was negative and the BOJ was negative, that flattened curves across the world that led to term premium coming down. So as the JGB yields continue to lift, that is going to mean that term premium lifts across the world, including in the US. So that should make for steeper curves longer term. So while it is priced in for next week, the BOJ is still quite consequential for global bond markets.
Okay, consequential for global bond markets. Steeper curves then, that takes us stateside, and that's where I really want to linger in this conversation with you, Banu, because you've got some really fascinating analysis back to the 90s about whether we're seeing a bubble in stocks right now, and what you... my broad conclusion is that you don't think this is like the late 90s and 2000. Why not so?
In many ways, Anna, right? So in the first way, it's not because you have high valuations today, but you have high valuations in companies that are giving you shareholder returns, right? You're getting dividend yield, you're getting buyback yield. The free cash flow yield is in a completely different postcode to the 1990s. So while companies are very highly valued, and let's just put a number to that. If you look at the cyclically adjusted PE ratio of the S&P, that is at 96th percentile of a century. So 100 years worth of data, you're at 96th percentile. When the bubble popped at that time, you were at about 99.5 percentile. So not a million miles, right? Valuations are high. The industry patterns seem similar. Leadership is very narrow. So there are some similarities, but the biggest difference is the quality of the companies. So there is no bubble. That I would agree with. However, when you say there is no bubble, then people come back and say, well, that means that we've got a runway for 3-5 years where the market's going to go significantly higher with supernormal returns. And that's where we would disagree even more strongly, because frankly, for all the talk about the tipping point, the data today does not suggest we are in a productivity miracle at all. In fact, productivity is about growing at 1/3 the pace it was growing in the 1990s. So we don't see that in CapEx or CapEx intentions or the productivity data. So the data so far doesn't suggest that. Sometimes economists don't have very good imagination, so there's a possibility that we're not being forward-looking enough. But
bit of shade there.
But I do think, look, we have to respect the data, and the data not just in productivity, but as I said, CapEx intentions, tech CapEx. If companies are that built up on AI, tech companies, you would expect them to be investing more, and we don't see that today.
So I'm short stocks, yeah?
I am sure. So in Magnificent Seven, we are not chasing at all at this minute. We think tech elsewhere, for instance, in Asia, parts of Europe, to the extent that there's tech in Europe, we're actually long Asia, we're long Japan, and we're long China, particularly the internet names in stocks. So we're not chasing Magnificent Seven, particularly Apple and Tesla, we're not chasing. But as a group, we think Magnificent Seven are pricing in a lot. So we have been long tech for a very long period of time. We're reducing our enthusiasm in the US on tech.
The topics... We heard a call earlier. Nobody seems to know what the upside potential is there. How unrelated is the topics trade to what happens in the States? If US stocks roll over, can the Japanese market rally?
So that's a very good question. So historically, you have needed to see negative returns in the US of about 8 to 10% for you to be able to see negative returns in Japan. And I think this time, because of COVID, economic cycles have become so delinked in so many different countries that I think if there's ever a time where Japan and China could delink with the S&P, it should be now. So I think there is a possibility that you see actually negative returns in the S&P and yet positive returns in topics. The question for Japan is, how does Japan do if the yen is appreciating significantly?
Okay,
right? So
yeah.
historically, when the yen has appreciated, large caps have performed quite badly. I think some of those correlations are spurious and they go back to Abenomics. But I also think that this is a time when we want to be looking at the domestic stocks in Japan. You want to be looking at retail, you want to be looking at banks, you want to be looking at some of the more domestic and defensive stocks, but also small caps. Remember, small caps in Japan have done very little. It's largely been foreigners buying.
Yep.
The Japanese themselves have been very disinterested in stocks. In fact, they've been selling stocks as foreigners have been buying them.
Yeah.
And that, we think, can change with these wage negotiations. And if CPI expectations begin to build up, then for the first time in a generation, Japanese local could move out of cash and start moving into equities. And that's a
You're
small
the
cap
second
trade.
person that said that this morning.
Yes.
Is that right?
Yeah, you're aligning. Mark Dowding, we're building out a very optimistic and bullish picture on
Japan.
on Japan
Japanese
equities,
stocks.
and this broader picture in terms of the elevation that's coming through there. Mark Dowding was on the ground talking about his experience there. When it comes, you touched on China. What is the catalyst for getting more exposure to China? How do you want to play? If you want to play that via domestic stocks, Hong Kong, the H shares, the A shares, or by some of the proxies?
So we're buying it in China. So, usually you buy sort of China satellites when you're bullish on China. This time, Chinese equities themselves are cheap enough that you buy Chinese equities directly. And within equities, we're long tech, right? So we're buying the internet names in China. They have done a much better job than some of the other companies in China of controlling their costs. And their ROE has improved. And their price to book has been coming down and their ROE has improved. So we are buying tech in China.
Is that a tactical call or a strategic call?
It is a tactical call, so it is a 6-month, 9-month call. And one of the catalysts you asked me about, I think one of the catalysts would be the pressure on dollar renminbi, the upwards pressure on dollar renminbi, so dollar strength fading. So I think very strangely, and not many people make this connection, but if the Fed is going to be more dovish than what is being priced in the market today, what's being priced in the market is 3 cuts. And if the Fed is going to be more dovish than that over the next 1 year and potentially over the next 2 years, which we think is the case, then the pressure on the dollar comes off. The pressure on the renminbi comes off. And the Chinese policymakers correctly have been really worried about dollar renminbi. So if the pressure on the dollar comes off, they do add more liquidity to the system, and that's when we probably see the credit impulse improving. And Chinese equity market does pivot off liquidity, so that's why 3 to 6 months, that's where we're buying.
Interesting, you were saying if the Fed is more dovish than market expectations. A lot of our guests have been suggesting that the risk is actually in the other direction, but you don't agree with that?
I do not agree with that. I think just before I sort of walked on to set, you folks were speaking about the possibility of 2 dots, and I think that will be consequential for the 2-year, but from 470, I think we're talking an upside of 485.
You don't get to 5.
I don't think we get to 5 again on the 2-year. And I think the possibility is 15 basis points in one direction and potentially 100 basis points over the next 12 months in the other direction. So I think even at 470, this is good risk reward with a decent stop. This is good risk reward. So I do not believe, because again, as you folks were saying, retail sales, payrolls, these numbers, and with the revisions on payrolls, these numbers are not that strong. So do we take signal in the growth or do we take signal in the slightly hot inflation data? I think growth.
If the Fed takes its foot off the brake, so the Fed does start cutting, and the economy, how big a risk is there that the economy reaccelerates or that just slows the rate of decrease? Because Powell gave us a big kind of boost back in December. I wonder whether he did the same thing in front of the House the other day. And financial conditions ease, the market takes off. How big a risk is there that happens this time around, if we only get 2 or maybe even 1?
Guy, there's a common refrain in the market that the minute the Fed eases, financial conditions will ease and the economy will reaccelerate. But here's the thing. A lot of what the Fed did in the last 2 to 3 years in terms of tightening is still to come through into the economy because people have termed out their borrowing for such a long time. So I actually think the opposite is true, that over the next 2 years, we'll still be seeing the tightening from March of 2022 come through the system, which it hasn't come through in terms of high interest costs. So I think for the consumer in the U.S., net interest costs will be rising, right? Even if the Fed is cutting. So I think this works both ways. If it's going to take some time. If monetary policy lags are longer, they're longer in both directions. And even as the Fed cuts, it is going to take some time for it to feed through to the economy. Now, financial conditions is the stock market and the credit market, both of which are very, very strong right now, and credit spreads are very tight. I think they can scarcely get tighter from here.
Bani, I want to go back to something you said at the start of our conversation, because I think it really caught my attention that the productivity expectations are not necessarily going to be delivered on because of a lack of capex. And yet you look at the excitement around AI, the number of companies spending a lot of money with NVIDIA. I mean, is what we're seeing maybe that companies can't get their hands on the stuff they want, or they're not sure what they're going to need yet because AI is going to be so huge they don't really know where to spend just now.
Do you know, it is a bit of a conundrum, Anna. It is a conundrum that what we are hearing in some individual micro names is just not being reflected in the macro. Again, I say this, without tongue-in-cheek, I say this quite humbly. There is a possibility that the micro has it right and the macro just hasn't woken up to it. But when I look at forward-looking data, you speak about unfilled orders. We look at unfilled orders. We do get data on that on a macro basis for electronic components and so on. And even looking at unfilled orders relative to inventories, these numbers are flat since 2015. So basically what's happening at a micro level is not moving the macro needle as yet. It's not big enough. Yes, NVIDIA, yes, OpenAI, yes, Microsoft, but it's not big enough across the sector. When you look at R&D research, when you look at information technology equipment, when you look at software, all of these, their growth rates are a fraction of where they were in 95 to 2000. So we don't see this in CapEx intentions.
95 to 2000. That was a great period. I loved it. Bonnie, nice to see you. It was fun.
We're going back down memory lane this week.
I'm very nostalgic.
Nostalgic, yeah.
80s and 90s. Fantastic. Barney, lovely to see you. Thanks very much indeed for stopping by to see us. Barney Buwaja, Chief Strategist at UBS Investment Bank. I want to take a look at the growth stocks out of Europe. It's been interesting. It's kind of been one day on, one day off for these stocks over the last few days. And again, that trend continues. Look, yesterday we were higher pretty much across the board here. Nestle's a little firmer this morning. But it's interesting that this is the kind of the trend that we've seen progressing throughout this week. Novo, LVMH, Ferrari, ASML, Schneider, which is a really interesting stock right now. One day up, one day down. What does that tell us about kind of market sentiment right now? Those are the growth stocks. You want to pay attention to those. We're calling them sensational six. Other people have their name for them as well. Granolas, all those kind of great things. The Fab Five, never been a fan of the Beatles. Joe Easton, I'm sure, is, though. That was even before my time. Joe, over to you.
So these are the deals movers today. We've got Vodafone up around 4% at the moment, selling the Italian business 8 billion euros, returning half of it to shareholders. Swisscom also gaining as well, despite that big payout from them. It will give them one of the largest operators of an internet provider in Italy, competing with Telecom Italia. And a couple of other deals to touch upon. Ageas, a report that BNP Paribas looking to buy a stake in the insurer. This is the company that's hoping to buy Direct Line in the UK, so been in the news a bit. And finally, down the bottom, Brought Up Partners Group, the private equity firm in Switzerland, because Bloomberg's deals team reporting that they're looking to offload around $5 billion in infrastructure assets. That's an exclusive from Bloomberg overnight. We will have a look at some other movers in the earnings space. First, I think we're going to bring up Brunello Cucinelli as one of them, which was hit hard. Well, first of all, we'll do Vonovia. Now, this one down 5% over in Germany, the biggest real estate listed company in Europe. Rental growth is weak, according to their report. But one stock going up is HelloFresh. You remember a 40% drop from them last week. Their earnings looking pretty much in line, so some relief. There isn't more weakness in that one, so we're seeing a 7% gain there. Brunello Cucinelli down almost 6% as the maker of cashmere sweaters sees a drop in profit. And we've got breaking news of the latest victim of a short seller report from Hindenburg. It is LPP. This is over in Poland. It's an online clothing retailer, and the short seller is saying that they haven't properly disclosed some information around their Russian business. We have reached out to them in terms of Bloomberg News, contacting them, not able to get a comment yet. But that stock down 18%. It's the worst performing stock we've got and the biggest drop for a number of years. Keep an eye on a response from LPP. Hopefully we'll get that soon. A quick look at chip makers. We've got that news that China telling EV makers to buy local chips, and we're seeing weakness in Infineon, ST Micro as well. They do supply into the EV space. The machinery makers not doing too badly, actually holding up. Bit of a less of a direct impact for them, but seeing some weakness in the chip makers. A couple of morning calls to bring you. Firstly, in Italy, Monte de Paschi gets a new buy. We don't get too many ratings on this one, but over at Keith, Bryant and Woods, they say that the overhang from the government stake sale is reduced, given they are reducing some of that holding at the moment, so they get a new outperform on that one. We're up 2% for Paschi today. But the biggest one to bring you is IAG. We got a double upgrade. Exane BNP Paribas goes underperformed to outperform from Exane and BNP Paribas today, up 4%, one of the best performing stocks on the market. They say that Heathrow Airport is finally full following the pandemic, and also their wage costs are coming down, which should boost the owner of British Airways, and that stock is up 3.9% in London today.
You set that one up nicely for Anna and Guy. Infrastructure, airlines, it's their two favourite things. Joey from our equity team, brilliant, thank you so much. Coming up, could this be the end of the EV production line for Fisker? This is a fascinating story as they look to raise capital after reports of a possible filing for bankruptcy. More on that story next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
To the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
22 minutes into the European session, European equities go nowhere in a hurry, but you look below the surface, there's some really interesting trades that are happening. Basically, it's kind of one day on, one day off for the growth stocks here in Europe. And that tells you something maybe about momentum and what is happening with this market. It's not just go, go, go. There's a little bit of caution maybe trading in to these markets as well. I want to talk about one area where there is certainly caution and a significant amount of volatility. That is in the stock of Fisker, the EV maker. Is it US-based? Is it Austrian-based? We'll talk about that in just a moment. The stock, as you can see, up sharply overnight. We're up by 43%. It was down sharply yesterday, this after the idea that this company could be filing for bankruptcy very soon certainly gained traction. The automaker now saying it's focused on raising capital, possibly talking to one of the large OEMs in this industry. Let's get more on kind of where this is going and the European implication for it as well. Craig Trudell joins us now. He heads up our coverage. Craig, it's a volatile story right now. We talk about one day on, one day off. Yesterday, everybody was expecting bankruptcy. Stock got absolutely dinged up. Then we see this talk overnight. Stock rallies hard. Talk to me about kind of where we are right now. What is the ability of management to save the business?
Yeah, the initial report by the Wall Street Journal, I should call out, did mention that they've hired advisors. So, this isn't necessarily, an indication that bankruptcy is imminent. But this is also not a huge surprise in the sense that they did issue a going concern warning in the last few weeks. It's a company that, wanted to try and take this approach of going asset light, of having a contract manufacturer handle the production. That's, oftentimes, as we've learned over the years, the hard part for these new EV up-and-comers. They thought that they could de-risk that by putting this initial vehicle into the hands of Magna, which is a highly trusted, highly reputable company that's been around a long time, makes a lot of products for a lot of established manufacturers in Austria. And even then, they are really having challenges. I think it's a company that, wanted to take this approach of, we're going to do the things for the consumer that they really care about, the software experience, and they haven't been able to deliver on that. So if you sort of make your proposition, I'm going to, leave the manufacturing to the experts. I'm going to handle the consumer user experience, and you can't even get that right, you're in big trouble.
That's the difficulty. And what's going on in Austria at this manufacturing site then? Because you've been there, you've been on the ground, you've witnessed this.
Yeah, so Magna Steyr is the name of the group within Magna International, which is a big Canadian company. It's a fascinating plant. They contract manufacture for many car companies over the years, and it's always kind of changing. There's a new product line that comes in as one phases out. You have the Mercedes G-Wagon made there. You have Toyota and BMW have their Roadsters made there. It's unlike anything else in the world in the sense that you have very different products rolling off the same assembly line, one after another. You do see that, of course, with manufacturers nowadays, where they may make a passenger car next to an SUV. But this, we're talking about not just different body styles, different companies altogether. They will be fine. They will, of course, not be thrilled about the fact that one of their customers is having trouble. But they have no shortage of interest on the part of manufacturers wanting to tap them to help.
What happens with the China story? So the line crossing 30 minutes ago or so that they're trying to restrict domestically in China. They want the BYDs, the Geelys, the Neos of the world to buy local rather than being reliant on US and European chip providers. How consequential could this be?
I think it's really interesting in that, for the car companies, it makes a lot of sense in that they want to de-risk things for their car companies, just like the U.S. Government wants to de-risk, the situation for their manufacturers. A few years ago, when we had such, disruptions to the supply chain, it was really debilitating for the likes of GM and Ford to not be able to produce because they didn't have chips. So I think there's a concern that, if trade tensions continue to escalate, how exposed are their domestic car makers? But it's also a story about the chip industry in China and the fact that they've had so much trouble bringing along these companies, and car makers buy a lot of chips. So if they're buying, that's very helpful to these up-and-coming chip companies in China.
Very nice, Craig. Thank you very much indeed. Craig Trudell, who leads our autos coverage here in Europe. We'll talk more about this a little bit later. Much more to follow. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
It's nearly a quarter of a century since Vladimir Putin first took power, and his adversaries both inside and outside Russia seem unable to stifle his ambitions, showing off Russia's military might in the lead-up to this weekend's presidential election, which he's sure to win. Now 71, Putin has outlasted world leaders from Angela Merkel to Silvio Berlusconi and held power through 7 British prime ministers and 5 US presidents. In over 2 years since sirens marked Russia's full-scale invasion of Ukraine, Putin's economy continues to weather the impact of retaliatory sanctions, with countries including China, Brazil, and India still buying Russian oil. Riding a rising tide of nationalism, Putin presents himself as a protector of Russian-speaking people. While the death of Alexei Navalny in an Arctic prison removed perhaps Russia's most powerful symbol of resistance. In the years ahead, Putin will have an opportunity to increase Russia's influence in the world, chairing the expanded BRICS group and continuing his friendship with Beijing. Putin. Now, with the war seemingly shifting in his favor, Putin is preparing not only for another term as president, but also possibly for a long confrontation with the West.
That was Bloomberg's Max Ramsey reporting on the Russian presidential election, heavily controlled, of course. That gets underway today. The election is the theme of a big take story this week. Joining us now, EMEA News Director here at Bloomberg, Ros Matheson, to give us some further details. Ros, good morning to you. So, I mean, the result of this the presidential election, heavily controlled system in Russia, it doesn't seem as if the result is up for grabs at all. You know, we know what's going to happen here. So what is Russia trying to achieve with this election? What are we watching?
Well, as you say, there's no spoiler alert here. Vladimir Putin will win the election. He's managed to crush both the political opposition in Russia, but also public opposition in Russia. There's no real momentum against him at this point. And also, you know, as we're just seeing, the economy is working in his favor right now. So there's no reason for him not to be re-elected. The question is, what does another Vladimir Putin term look like, or potentially another 2 terms even, is on the table as far as he's concerned. So what does that look like both for Russia, but for Europe, for Ukraine, and the rest of the world, including the US? Because, of course, we've got the US election cycle to think about in all of this as well. What does it mean at home? It's probably going to mean that he's coalescing power even more around himself. We are expecting a potential reshuffle of some of the top ranks underneath him in the aftermath of this election, and that's one thing for us to watch for, which is the question in the future at some point down the line where Vladimir Putin is no longer in charge, then who takes over in Russia? And does he start to nominate someone who would take over, be his protege? He's been reluctant to do that for obvious reasons in the past, but we want to look at who comes up in this change and who to watch for as a result.
Okay, that's interesting in terms of the context of the leadership in the future for Russia. What about the state? You touched on the economy, the relative strength that's come through for Russia. How has the Russian economy been able to weather this barrage of international sanctions?
Well, basically, there's been a blizzard of spending inside Russia. He's put the economy on a wartime footing. That's producing a lot of stuff, obviously, for the war in Ukraine, ammunition, artillery, and so on. He's got factories working hard to crank all that out. You've got a labour shortage because a lot of people in Russia, men in Russia, are in Ukraine fighting, so salaries and wages have gone up, and that's propelling the economy because people have more money to spend and they feel happier in general as a result. And so you've got wages rising, labour shortages, factories working, and Vladimir Putin is also selling stuff still to a lot of countries around the world despite those sanctions. He's sanctioned heavily by the West, but doing a lot of business with China, with the Global South, even with India and other countries, and so still buyers for Russia's energy despite all of that. So a lot of levers he's pulling to keep his economy ticking along.
Is that sustainable? Are we going to see further sanctions? Why aren't sanctions working? Why? The idea was here that we would be able to slow the economy down, slow the war machine down, therefore degrade the ability of Russia to fight this war. Why is that not working?
It's maybe that existential question of, do sanctions ever work, or do they ever work against the people or the industries or the leaders you want them to work against? In this part, you know, he's sanction-proofed his economy over a long period of time before he went into Ukraine. So can his economy be self-sustaining despite those penalties? He's managed to do that. They've appropriated some foreign businesses that were operating inside Russia. They've taken those back, nationalised those. So he's really got all those levers again he can pull. But in the longer term, those economic challenges are going to rise. You're going to see inflation at some point kick in, a ginormous budget hole that he's going to have to fill. So he's sort of borrowing now to have to pay back later. And the question is, at some point, what economic hit do we see in 5 years from now, and how does he deal with that?
Yeah, and these sanctions are designed in such an intentionally nuanced way, aren't they, with the cap, not wanting to take the oil, for example, or the energy products out of the system necessarily, just not wanting to sell them to the West and sell them at a controlled price. Thinking about where we head next, and Guy's point about the war in Ukraine, thinking about how long it lasts, we're going to get a meeting today between France and Germany and Poland. And the Polish leadership, of course, coming off the back of a trip to Washington, no doubt interesting to hear from them, their takeaway. They've described it as quite a tough environment, I think, to talk about the war in Ukraine in Washington right now.
It's going to be really interesting, in fact, to watch that meeting, to see the optics, particularly between the leaders of France and Germany. As we know, there's no love lost between Emmanuel Macron and Olaf Scholz, and that's really been on display, particularly in recent weeks. And can they sort of paper over that in this meeting today? What we know is they're going to meet for about 5 hours. There's no planned press conference, which tells you something at this point afterward. Are they just at least going to be trying to echo each other in terms of their stance on Ukraine and the need to support Ukraine? That would just be a beginning. In a way, we don't expect major news about policy on Ukraine or aid for Ukraine from this meeting. We probably expect a bit of conversation around the need again for collective defence in Europe to pick up. The idea of, again, do you see Vladimir Putin, turn his eyes further towards Europe in the coming years? Does Europe have to prepare its defence on that? But the most interesting thing to me out of this meeting is going to be the optics again between the leaders of some of the biggest economies of Europe, Macron and Scholz, and this dispute that they seem to be having over their positions on Ukraine.
It all feels very glacial, the Western response now to Ukraine. They're running out of money, they're running out of military equipment and hardware, ammunition to provide to the Ukrainians. We talk and we phrase and we describe the $60 billion in the US as being held up. I mean, is that essentially just kind of dead in the water? Is there any sign as we lead up to the election in the US that money's going to come through? What's next in terms of the support for Ukraine?
Well, that is the big package that matters the most to Ukraine, alongside certain types of advanced missiles that they want to get from the Europeans, which is also being held up, as we know. But that package, there's just no political momentum to get it done in Congress. And as we get further and further into the US election cycle, at this point, we know it's going to be Donald Trump versus Joe Biden in November. And as things harden around that campaign, where is the momentum going to come to get that thing through Congress? Republicans are really taking their cues at this point from Donald Trump. Trump has made it clear he doesn't want that package to happen. They're not going to go against him in Congress on that. So you really need a lot of goodwill to push that thing through. At this point, there's no prospect of it passing.
Ros, nice to see you this morning. Thank you very much indeed for bringing us up to speed. EMEA News Director Ros Matheson. Do the Europeans have to step up in that case? What does this do in terms of the budget story here in Europe? Europe under significant pressure to increase its defence spending. But if it has to fund more of the war in Ukraine as well, that's going to stress out some of these budgets even more. They're already being pushed pretty hard.
Yeah, we're coming off a pandemic where there was a lot of spending to support societies in different ways around Europe, but to support societies on that front. So we're still dealing with the post-pandemic debt load, and then you add in a new imperative, which is around defence spending, and involving the private sector in this, clearly very important. The flow of money from the EIB, I think, interesting to watch. We certainly heard that line from Saab asking for better signalling about where money from them was allowed to go in terms of defence spending.
And that conversation around spending and whether or not you have war bonds, essentially, it's been muted by some, or raised by some Eastern European nations, but the view seems to be that there's no consensus on that.
Well, Ross is bringing up the tension between Germany and France at the moment. That seems to be at the core of this. Germany very much resisting that idea that we could see that move. But as Anna was bringing up earlier on this week, huge demand for that potential. If you were to see those AAA-rated bonds coming to market, that would be something that the market would be very keen to deliver on. So that there's not resistance from the market to that idea. It's just a political resistance coming out of Germany and that incredibly fragmented coalition that they've got at the moment.
Yeah, it's interesting that you can have a AAA-rated bond even when the key protagonists, the key sort of people behind it don't necessarily agree on a whole host of really important factors, but we'll continue to watch that one. Coming up on the programme, we're going to pivot to another interesting story for us to cover this morning to do with drug makers keeping a keen eye on regulatory meetings in the United States that could cause waves in the sector. We'll bring you that next. This is Bloomberg.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. Happy Friday. This is Markets Today. We are, 43 minutes into your Friday trading session. And as you can see, it's a bit muted across the European equity space. There's a little bit more interest coming through under the hood, and particularly within the commodity sector. If you look at things like iron ore and copper and the divergence there, US futures pointing flat as well. Nasdaq futures down by 0.1% after 2 straight sessions of losses for US stocks. But really, the central bank action of the moment as we lead up to next week is the story unfolding, of course, around the Bank of Japan, and the wage data from one of the key union umbrellas seems to build out the evidence that the Bank of Japan does have the space, if they should choose to raise interest rates next week for the first time since 2007. So the Rengo, which is a federation of unions, saying that its members secured deals, wage deals worth 5.28%, averaging 5.28%, so well above last year's approximately 3.8%. So with the increase coming through, and again, we know that the BOJ is focused on wages as it comes to that view as to whether or not to raise interest rates next week. So we continue to keep across that story for you. We'll get more analysis right now, bringing in our senior executive editor for macro markets, Simon Kennedy. Simon, where do you land then? What are the markets saying? What are investors saying about the BOJ and the potential impact, global impacts of this?
So the debate until this week was March or April for the BOJ, and you've seen this steady stream of commentaries. And this morning alone, you've got the wage data. After that, Toronto Dominion, Rabobank were among the banks shifting their forecasts and saying it will be next week. John Authers on Bloomberg joking about whether this is finally the week that Lucy allows Charlie Brown to hit the football. It's been a long time coming. And the wage data and the views of many, probably the market as well, kind of confirms it, but doesn't fully cement it. There's still some skeptics out there. You're seeing a bit of yen weakness today among broad dollar strength. That would seem counter to what you'd expect otherwise.
For some people, there's Charlie Brown and Lucy. For others, there's waiting for Godot. This has certainly been a long time coming, hasn't it? And many people have been betting on this happening, this direction of travel for a long time. Is there a danger that next week, actually, some of the detail leaves us a bit more confused than perhaps the headline story, Simon? Because we've had already some kind of different explanations as to what exactly we might get next week. Because there's moving away from negative interest rates, there's yield curve control, and then there's things they say they'll do but don't implement till later. It might end up being a more nuanced picture than just they did or they didn't.
Absolutely, and the Bank of Japan is one of the most nuanced central banks in the world, merely because it's got all those different tools and then the challenge of being translated and all these things add up to quite a bit of confusion. They're not alone in that camp. There's lots of central bank confusion. We may get some more from the Fed as well next week. But certainly this is a difficult task for the central bank, not just to make the move that is now seems more likely than not, but to then communicate what it does next and what it won't want to do. And Bank of Japan has this long history of kind of acting and then having to reverse not so long after. They'll want to get this feeling of escape velocity, and perhaps that's the one thing that holds them back into the next month is, do we definitely have it? Do we definitely have this sorted? Can we move and then come and then keep moving, or at least hold in that position for some time? But you're right, there's lots of moving parts here.
Janet Henry from HSBC, chief economist, says she thinks they're one and done. Others take a different view. I note with interest that the yen is actually weaker this morning, which is in some ways sort of counterintuitive, but you plug in what's happening with the Fed. So next week, let's have a little speculation about next week. Fed comes out, says we're only going to go twice this year, and the BOJ hikes. Which of those two things could be the more powerful force in terms of the way that the market narrative develops?
So I think a few months ago it was all about the BOJ. We saw lots of stories about how the BOJ is this anchor. It's the last one with a negative interest rate. It's holding everything back. And then more recently it's developed, its communications partly to be credited, but the market has kind of come into this view. It's softly landed on this view that the Bank of Japan will hike next week or next month. And so, what will cause the problems is the confusing what's next question. But the Federal Reserve has got this issue that it's got this dot plot, the famous dot plot. It last updated in December, and now it could come back and say, actually, we only see 2 cuts this year. Which would be a huge turnaround, not necessarily for the Fed, but for the market. Deutsche Bank's got a piece out this morning saying that this is the 7th time the market has prepared for a dovish pivot from the Fed in this cycle, only to be told again.
Setting us up for them, and then disappoints
with the dovish language of last week in testimony. How vulnerable then is the equity market to a revision of the dot plots from 3 to 2, if that came through?
Well, I think that the market that's kind of more sceptical is the bond market. You're seeing this week the yields go up already in preparation for that. I think with the equity market, the challenge is is it irrational exuberance, or is it just a group of really strong bullish stocks out there kind of driving the momentum? And the opinion of most seems to be the latter. So, but again, the more questions you ask about, say, a stock market or any asset, if you're asking the question, you're kind of answering yourself as well. But we'll see that certainly the Fed has this potential to ruffle things again next week.
It does, and so does the BOJ. But your point is well made about the Fed. But it does seem amazing how stocks have managed to really ignore the retreat that markets had, that high expectation of rate cuts earlier on this year, not to mention last year. Such a retreat from expectations around rate cuts, and yet stocks power forward as if actually they're very focused elsewhere. They're focused on the growth story, the AI story, the possible delivery of productivity gains. So I wonder in that context whether either the BOJ or the Fed next week cuts through, and actually it could be something micro, could be something on the corporate front.
Absolutely, and I think again to mention John Authers, he was talking about that this week. So yes, you're quite right. You've got these fundamental strengths. You've got a narrative that explains why stocks are up rather than too much money in the system. And certainly we'll have to wait for next week's Fed decision just to see whether they can absorb that. But it certainly seems their eyes are on other things other than the Fed.
I'm firmly in the line of kind of referencing Peanuts. That's much better rather than
Waiting for Godot.
Oh my lord!
Cultural reference.
Yeah. Oh my lord! But not the most exciting of plays. Let's put it that way. Simon, thank you very much indeed. Senior Executive Editor for Macro Markets, Simon Kennedy, reacting, trying to figure out what the story is, which one has the most influence next week. In some ways, given what we've seen today with the data on the wages, the biggest surprise may be that actually we moved to 2 cuts this year from the Fed.
Maybe it's all priced on the BOJ. But I do remember sitting there early hours of a BOJ morning and looking at the headlines and finding it difficult to join the dots between the expectations going in and the headlines you're seeing. And it often does take quite a long time to work out exactly what the communication.
Saying they're very nuanced. I mean, otherwise you could just describe it as very confused. This is a central bank that has multiple different options.
And sometimes that's by design.
Do the forward guidance.
Sometimes that's by design. I think it's really interesting. You mentioned this earlier that we've had 2 guests talking about Japanese stocks being really positive on Japanese stocks, and I was drawn to a column by our colleague Daniel Moss talking about how everyone's got a crush on Japan right now.
Except for Japanese domestics.
Right, and maybe that changes a bit, and that's part of the reason why Mark Dowding was certainly so positive on Japanese stocks. But he was saying that this idea of a crush on Japanese assets and all the expectation and the hope around Japan, maybe it is just an overly simplistic narrative, and you do wonder if rates are, we're changing, we're pivoting. It's certainly a big story, but if they're not going to get that high,
price to book. A number of these companies in Japan are trading at less than 1 price to book. So the valuation is there. They still look cheap, even though they got the run up to above 40,000, on 38,000 today.
Even with the crush.
It's
interesting to see how the exporters trade. I want to talk a little bit about what's happening on the science front. I'm not sure I can make a pivot from the BOJ into the FDA.
The science of monetary policy.
They've got 3 letters. That's about as far as I get. So the US Food and Drug Administration is going to, a little later today, convene a panel of experts to discuss whether 2 cell therapies that are led by Legend Biotech and J&J, and another one by Bristol Myers, could be used earlier in patients with cancer. Now, this is really significant. Up until now, and we're talking about immunotherapy here, this is super cool science, has been only used on patients that are much further down the road with myeloma. And this could be the day when actually that changes and this science gets rolled out to cancer patients that are much earlier in the progression of the disease. You want to pay attention to this stuff because this isn't Ozempic, but this is big stuff in the science world. Bloomberg Intelligence Senior Pharmaceutical Analyst Sam Fazeli, perfect person to talk to about this. Sam, talk me through the science and talk me through what the FDA is looking at today.
Yeah, thanks for having me on. I just want to first say that I think the last time we talked about anything to do with FDA and regulatory conversations coming up was to do with vaccines, right? Yep. This is not a normal topic of conversation for us. So why are we talking about it? Because it's a revolutionary therapy that they're bringing on. It's so-called one and done. It's not quite right, but it is. You don't go for a third one and a fourth one and a fifth one every 3 weeks. Yep. You take cells from a patient, engineer them in the lab, give it back to them, and you essentially in the lab train them to find the cancer. And when they get it back, it goes and kills their cancers. So, and you have just one shot. It's magic, right? Now, it doesn't mean that those patients are all cured forever, but they can, and we're seeing the data that's going to be presented today and argued over today. How much benefit are you getting from them? Is this an increase in survival by 20%, 30%? Are you having 10 more patients cured versus not having used this therapy? And remember, they don't go back for more shots, right? So that's where the revolution comes. But of course, you can do this training of these cells for any disease, right? You could do it for other types of cancers. Blood cancers are easier. Myeloma is a blood cancer. Are relatively easier to address because the cancer is in your blood. The immune cells are in your blood. They see them. Solid tumors, lung, prostate, etc., are a little bit different. Because they have this solidity around them that stops the cells getting in. That would be the next revolution, and then we have another one to talk about.
Okay, so this is immunotherapy you're describing, and this is where all the high hopes are then and expectation. But what should we be looking out for today? You've described a lot of the advances here, Sam. I imagine that the FDA conversation is also around the risks. What are you watching out for today?
That's absolutely right, Hannah. The efficacy is pretty easy to understand, or at least you see it. You've seen the data. The question is how worried should we be about the safety? If you're a cancer patient and you have no other options left, that safety may be something that you accept, that extra toxicity, right? Because if it gives you another year or 2 years of life. If you're a patient who's early on in their disease, where you're not likely to die for 10 years or 5 years, what is the risk that you're prepared to take for X amount of benefit? Then you take it outside of that and you take it to what's so-called autoimmune diseases, because it's the same. Multiple sclerosis, lupus, rheumatoid arthritis, Crohn's disease. These are often driven by also cells that have gone awry. So if you can kill those cells, you reset the disease. And there's data that shows you literally reset the disease. But in those patients, you want absolute safety, because you're not going to expose somebody who's just got RA and but suffering from in daily life. This is where this conversation today is important. It's got ramifications for a lot of things.
Well, just let us draw you out a little bit more on the ramifications. You touched on some of the other diseases and the other challenges that this science could be used for. What are the timeframes for some of those treatments coming through? I mean, how close are we to having the therapies needed to tackle some of those diseases?
Yeah, for blood cancer, we're there.
Right.
This is already approved for people in fourth line, really late stage disease. The question today is, can it be used, as you said, second line? For autoimmune disease, there were some papers, data that was published from a German group a year ago or so, but noise had been gathering, so lots of people are trialing it. When will we see something on the market? 5 years. If everything works out.
Yes. Okay. Something to watch for today then. Thank you very much, Sam. Sam Fazeli joining us there, Bloomberg Intelligence Senior Pharmaceutical Analyst. Yeah, it does tell you something that the last time Sam was a sort of daily friend of the show, we were deep into COVID.
We're going to have him back more often.
We're going to have him back more often.
This is cool science.
To talk about some of the opportunities here. So thank you very much to Sam for joining us. Just worth flagging a few things coming up today. 9:30 UK time, the Bank of England and Ipsos will release their inflation expectations. 2 o'clock, we get Michigan Sentiment Index. That's important on the US data side of things. It is US triple witching, rebalancing data, also important to watch, so we'll continue to watch that. We get a Nigerian CPI release, and finally ECB's Lane and Vucic will be speaking. There's been plenty of ECB speak. That won't necessarily be the focus of next week, but there'll be plenty of other central banks to focus in on.
Next week, big central bank week. Plus we've got this NVIDIA event coming up. I've just enjoyed Friday. just enjoy Friday, because next week you're going to have to buckle up again. Anyway, Tom, thank you very much indeed. Great to see you. We'll be back again Monday to deal with next week. Have a great weekend, everybody. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today?
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups, is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly. We're Monzo. Give us a go.
See? I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Okay, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Year that came through, which really was kind of this key catalyst for the rally that we've seen. But as well, I think it's interesting that corporates have been able to display pricing power. We had the quarterly Tankan survey, which did suggest that input costs are easing, but yet output costs are actually remaining sticky. So they are displaying this pricing power. And I think overall, that justifies a higher valuation premium for Japanese equities. So even if we do see this rate hike, Japanese strength at the margin, we still think there's upside left in Japan.
Laura, I mean, I find it amazing, actually, that we're here and that it's been so well telegraphed. What could actually go wrong?
I think certainly from a Japanese perspective, if we start to see them, hike much more quickly than anticipated, and the implications that that could have on global yields. I mean, at this point, we are neutral on our U.S. duration position, largely because we think the term premium argument in the U.S. has yet to play out. But we think that's more of a U.S. fiscal story that is yet to play out probably later this year and certainly over the medium term. So I think the risks at this point are largely contained. And yes, tomorrow may be interesting, but I think it's really just going to be a move at the margin.
I mean, the Fed kind of, rules them all still.
Yes.
Has it changed your view, the inflation number, of how quickly we can get a rate cut?
I don't think the inflation print, certainly we saw the upside surprise in U.S. core. We saw the PPI print yesterday. It doesn't change our view. And I think what's been most surprising, it hasn't really changed the Fed's perspective as well. We're continuing to see this consistency of messaging, suggesting that they're still in line with market expectations for just over 3 cuts this year. Of course, next week, I think will be quite crucial in terms of that SEP and the dot plot and whether we actually see one of those cuts removed this year, because that would suggest that they are shifting focus to the inflationary backdrop, the risk of a reacceleration, and the fact that we could actually be in this higher for longer rates regime, and they may not hike until later this year.
And I've heard this actually from a lot of the big Wall Street titans saying, a couple of warnings here and there that maybe we're a little bit too optimistic about the U.S. economy going forward.
I think the key risk that we're watching for in the U.S. is just the potential resumption of price pressures. I mean, if we look at the super core gauge that we saw released earlier this week, which tends to be the Fed's preferred measure within CPI, it did surprise quite sharply to the upside, about 0.5 month on month. If we start to see more of those sequential surprises, I would suspect that markets are at risk of, extrapolating this disinflationary trend further out. That could be quite, a surprise to the markets. But what's been interesting is the fact that equity markets have actually been fairly resilient on the back of this rates repricing. The key question is, can they continue to maintain this momentum if we were to see further cuts priced out? And probably that leans us a little bit more of defensive positioning, looking overall at equities.
Laura, I mean, there was a big move in gold, but actually the ETF didn't really quite move with it. I don't know whether that tells us that the market is almost positioned for like a Fed mistake, or doesn't quite have the trust that the Fed should have from the markets.
And that's actually been an interesting kind of divergence that we've seen over the past number of months. We're continuing to see gold outflows looking at global ETF positioning, but yet gold continues to test record highs. In our view, the key underpinning of that is likely central bank buying. And as well, when we speak to our investors, they are using gold as that key tail risk hedge, because where real rates are trading, gold should be much lower, but yet that's really kind of the go-to hedge in portfolios.
All right, Laura, we have so much more to talk about. Laura Cooper, their senior investment strategist at BlackRock, stays with us. Plenty more ahead. We'll also talk credit in Europe. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome back, everybody. Now, still with us, Laura Cooper, senior investment strategist at BlackRock. Now, Laura, we spoke about the yen, talked about Japan, we talked about the Fed. What we haven't talked about is actually Europe and how you play that through maybe credit and equities.
Yeah, I think Europe's is certainly an interesting story. I mean, we are starting to see signs that economic data has troughed. The ECB is clearly on the cusp of an easing cycle. So this does really pivot us more towards European equity exposures and as well looking at kind of the European credit complex. I think it's been interesting in kind of the European equity space. You know, we have seen qualities really start to outperform. That's really the underpinning of our view. The fact that, you know, we are seeing tech, healthcare, and luxury be those dominant drivers. And the fact that those are showing that pricing power, that margin resilience, those earnings expectations that are upbeat, we think it's now is really the time to be selective in cyclical exposures, tilting more towards that quality front.
I mean, we're also 100 days, I think, from the European elections. Do you wait until that happens to decide whether you buy government bonds?
Not at this juncture, actually. We've actually had a preference for periphery government bonds. I think Italy certainly has outperformed. Looking at German bonds, looking at that BTP bond spread has probably surprised our expectation, dipping below that 125 basis point mark. We still think it's a very attractive carry opportunity in Italy, looking at kind of that low spread volatility. And we are seeing quite strong retail demand as well in Italy. I mean, we're watching the key risks. The EU parliamentary election is one of those risks. We're also watching for revisions to the fiscal deficit. But I think at this point, you know, the yields on offer are quite an attractive opportunity without that clear catalyst in sight for us to take on more of that kind of core haven type of exposures.
But so when you look at some of the equities that you like in Europe, and you mentioned luxury and you mentioned some of the big companies, is it companies that have little exposure to China, or how do you view that, the kind of that dynamic?
I mean, I think we aren't necessarily kind of allocating to those exposures that don't have any allocation to China. I mean, we're still going to see China, that fairly steady type of 5% growth potentially. But I think the way we're playing is through very selective sector exposures. So healthcare, for example, is one that we really like. Positioning is light, valuations are not stretched. It's going to benefit from kind of this tactical defensive type of positioning. But if we think about kind of this key mega force around aging demographics, we think healthcare and the structural demand supports are going to be significant there, and then overlay that with what's happening in AI and the potential for pockets of healthcare to benefit from innovation. We think that's yet in the price. So I think there's really attractive opportunities in Europe, despite the fact that there are still growth risks coming from some of their EM kind of demand counterparts.
What do you do with the UK? A slightly different job for the BOE than it is for the ECB.
I mean, perhaps the UK has been an interesting one in the sense that we're probably going to see the Bank of England cut more than current market pricing. So that does advocate for shifting duration exposures across the gilts complex. I mean, we're not taking on very long end exposures because we do think kind of the fiscal backdrop will come more into play, particularly as the Bank of England has been a kind of a dominant holder of that government debt. And they're, under the QT dynamics, won't be that ballast of support anymore. So again, there are opportunities within gilts. UK equities, there are, again, pockets of opportunity, particularly if we start to see, more pronounced sterling weakness.
So you're expecting cuts to maybe come a little bit further down the line, but then more of them as the year progresses?
I think the fact that inflation still remains quite elevated and the core prices continue to remain sticky. We have this kind of artificially kind of tight labor market on the back of a number of supply shocks. Perhaps that leans them to cut, probably not until Q3, maybe August, so after the Fed and ECB. But I think the degree to which they're going to cut is probably greater, just looking at the economic challenges and the fact that the UK economy, tested that recession last year. It continues to show signs of stagnation. Productivity remains exceptionally weak. There's a number of key kind of risks, I think, for UK overall.
Anything in sterling, or it's just not the right pairing?
I mean, our preference is probably tilt more towards kind of other more attractive carry opportunities. I mean, EM offers very attractive carry opportunities in the FX space. I mean, I think overall, when we look at the dollar, we're probably at the peak of the dollar strength. Certainly, the upside surprises in the data, add a little bit less conviction to that view. But I think overall, the fact that rates have repriced as much as they have, there's probably limited scope for that to go further. And as well, if we think about the U.S. economy, we struggled to see how this resilience can be maintained. So if we start to see the deterioration in U.S. growth alongside bright spots emerging in Europe, my preference would be to shift more into the kind of the euro-dollar space rather than looking at sterling exposure in particular.
Laura, as always, thank you so much for joining us. Laura Cooper, they're a senior investment strategist at BlackRock. Now, coming up, Blackstone's John Gray says real estate prices have bottomed and it's time to act. More from our exclusive conversation next, and this is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
One concern would be that central banks, having been too dovish early on in terms of not raising rates, not shrinking their balance sheets fast enough, that as inflation is coming down, and I think they have air cover, that they're going to be patient because they don't want to be too quick this time to stimulate things, to bring rates down. And so I think we could see a little more of a slowdown. That's a possible risk out there. As investors, it's interesting. I would say one of the things I worry about is that we wait too long, particularly in some of the sectors where there's been a bigger decline in value and people are more cautious. So we had a meeting this week with our growth equity team, and we were talking about some of the opportunities in that space. A lot of investors are obviously cautious there. Commercial real estate, which I'm sure we'll talk about. The sentiment has gotten quite negative and the fundamentals feel like they're bottoming. So I think as investors, sometimes one of the risks is you miss it by being overly cautious. And I think now is probably a good time before rates come down to move.
But move on what? And again, do you have an allocated, capital that you want to try and get in as soon as you think,
There's no sort of specific, like, we have a budget to spend this much. It's just more directional. It's that, in fixed income, the spreads in a lot of asset classes are still wide by historic standards. Base rates are still pretty high, so that's a good area. Being a capital solution provider today, helping people get some liquidity makes sense. People who need to deleverage, working with the banks and giving them some capital relief. And then particularly in sectors where we have high conviction in digital infrastructure, in green energy, in life sciences leaning in. So I would say it's pretty broad-based. And then specifically on real estate, definitely here in Europe, the sentiment's so negative, try to move faster.
And so, but are there opportunities actually in commercial real estate? And you have to fight them off with some of your formidable competitors as well, because now's the right time to get back in.
There are definitely opportunities. I would say the sentiment is more negative. The competition is not as great as normal. Real estate's obviously been hit by two big forces here. One, work from home, which has really hit the office sector. And the second is the rise in interest rate, which has caused cost of capital to go up and caused multiples in real estate to come down, cap rates to go up. And so what you want to do in this kind of environment is look through that, because that's occurred. There are going to be tons of headlines of market transactions that were priced in a different world that will run aground now. You'll read about them in banks, maybe insurance companies. But on the ground, we're seeing cost of capital start to come down. Spreads are starting to tighten, and new construction's coming down dramatically. So in sectors that we really like logistics, benefiting from e-commerce, digital infrastructure, student housing, hotels, we think there are opportunities, and we've done a number of multi-billion-dollar transactions.
But is there a danger that something goes under in the commercial real estate space that infects others? That could snowball into a systemic issue even?
I don't think it's systemic. I think there are financial institutions that have investments or loans that were made in a different period of time. And we've seen that most recently in New York Community Bank. And those institutions are going to have to mark those assets to market. Those loans will come due. There'll be needs for new capital. There may be some institutions who get into more trouble. I don't think this is like 08 and 09 in terms of the scale of what we were facing, but I do think there'll be some situations. But that's what creates the opportunity. It's because the perception is so negative, the headlines are negative, and yet the value decline has occurred. I'm not saying there's some V-shaped recovery, but when you get into this bottoming period, that's when you want to try to move.
So when you say getting into a situation, this is what companies actually going bust?
Well, there are definitely assets that were financed in a different area. Particularly, you focus on commercial real estate because there's been a more profound impact, certainly in the office sector. And so I think that will create opportunities. We bought a $17 billion mortgage loan portfolio with the FDIC from Signature Bank. Those are the kind of opportunities. There may be more of those that emerge. But I think saying that this is going to lead to a much broader systemic issue, I think that would be too much.
I mean, there's growing competition, of course, in the asset management world for retail PE. How does that change how you do business?
Well, I think at the end of the day, if your customers are pension funds, sovereign wealth funds, insurance companies, or individual investors, at the end of the day, you have to deliver good returns. It's like a restaurant serving good food. And if you don't do that, the customer is going to go elsewhere. Now, the distribution format is different because you're not talking to a couple hundred customers, talking to a couple 100,000 customers. The structure of the vehicles can be a little bit different in terms of their liquidity, their yield, their tax structure. But to me, the end product is the same. And what we're trying to do is leverage the enormous scale and insights that Blackstone has in terms of what we see in the world, the people we have on the ground, and then generate more favorable returns. And then deliver that to different underlying customers. But it's, at the end of the day, really the same product.
But isn't it, in part, fundamentally changing the industry, or at least, the business model of some of your investors?
I do think the business is evolving. I mean, if you went back and you said, what was this business 10 or 20 years ago? It was private equity, real estate private equity, and opportunistic credit. You were seeking to get 20% gross returns, 15 net. And now what you're seeing is, as we've moved into some of these lower returning, longer duration vehicles, core plus real estate, infrastructure, performing credit, the universe of potential investors gets much larger. The universe of potential assets to invest in gets much larger. And so a firm like ours and some of our competitive firms have benefited and grown a lot in scale. I think the good news is we're still pretty early days in this process.
Well, that is the Blackstone president, John Gray, speaking exclusively to us from the Bank of America Global Investor Summit in Rome. Now, this is a picture for U.S. futures. Again, stocks ending the week a little bit muted after the latest U.S. inflation data weakened the case for an imminent Federal Reserve rate cut. I'm looking at S&P futures practically unchanged, as are the Stocks Europe 600 and the NASDAQ futures. Now, the one thing we watch out is the Japanese yen weakened after the country's largest labor union group also announced a blowout wage increase, which may actually now nudge the Bank of Japan towards raising interest rates for the first time since 2007. The other thing we watch out for is copper, and then you can see iron ore down some 3.3%. Coming up, the last piece of the puzzle, well, Japan's largest trade union reports a more than 5% wage hike. So what will this mean for the BOJ? We'll have plenty more of that next, and this is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Speculation grows the BOJ will hike interest rates next week after Japan's biggest union group announced larger than expected wage deals. European stocks and U.S. futures waver as hot U.S. PPI data gives the Fed more reasons to delay cuts. Plus, Russian votes in an election that is all but certain to extend Vladimir Putin's rule by 6 more years. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacroix here in London, and happy Friday. Now, members of Japan's largest union group secured annual wage hikes of more than 5% in what may be the last piece of the puzzle, pushing the BOJ into raising rates next week. Now, for more on all of this, we're joined by Jane Foley, Head of FX Strategy at Rabobank. Jane, this was a very exciting blow-up wage result. Does it change your forecast expectations from when the BOJ goes?
Well, you know, I think we've seen economists and traders alike putting more emphasis now on that March meeting. So if we went back to the end of last year, there was more consensus around an April move, but actually it does look as if March is very high on the agenda for a potential policy move. Because if we've got all of those pieces in the puzzle, why wait? You know, that's the argument. So I think it's going to be a very, very exciting and really quite an historical moment potentially for the Bank of Japan next week.
I mean, it is because they've taken so long or they've tried to pursue this goal of achieving 2% for such a long time. I mean, is one result enough to really convince them to go?
Well, you know, the 2% target, you know, that was introduced some years ago by the former Bank of Japan governor, and this was all about psychology, and psychology has been very, very important for the Japanese market, and this really does stem back, you know, 30 years since the bursting of that bubble, when the psychology that was adopted really by consumers and corporates alike was one of, you know, keep assets off the balance sheet because of the, you know, assets at that point in time were going lower, keep costs down, and it got to the point where inflation could not be passed on. So nobody was prepared to pay higher prices for anything, and firms couldn't pass prices price hikes on. But that has changed, or that is changing. It's in the process of changing, and that's so important for Japan. And you know, we're at this moment now where that virtuous cycle looks as if it's been cranked into motion, and part of that has been the structural reform, or perceptions of structural reform in the equity market too. The perception that there is more transparency, that the government has been trying to increase transparency to make that market more attractive to institutional investors. And also, if big corporates can pass price hikes on now, it becomes a lot more healthy. So there's a lot of things coming together now, which isn't just about the wage hikes, although that is fundamentally very important.
Yeah. So, Jane, if you look at the wage hikes, I mean, is it also a combination of some of these bumper profits at the companies, you know, along with the labor shortage that kind of, you know, risen to that? And again, is that sustainable?
Well, you know, the labour shortage is very, very interesting because if you go back a couple of decades, people would say, oh, you know, one of the reasons that there's disinflation, deflation in Japan is because they've got an aging population. Older people have a lower propensity to consume. But actually, if we look at a speech by Governor Ueda, for instance, in late December, he was saying, no, you know, the aging population, now that the baby boomers on average are hitting around about the age of 75 years, you can't expect older workers to come into the labour force. You can't expect more and more women to come into the labour force because that's becoming saturated. And actually, there's going to be more and more signs of labour shortages in Japan, which is going to help keep wage inflation higher. So that's a really important part of this puzzle too. We've got to consider in Japan, you know, average ages of construction workers, of farmers, they're in the 50s or maybe even their 60s. You got to the point where around about 10% of agricultural land in Japan is reportedly not being used just because there aren't enough farmers. The farmers are too old. So we are at the point now where certainly the Bank of Japan governor expects that labour market shortages are going to become far more acute, and that should be a positive sign for wage inflation.
So, Jane, what's the right trade for yen? Is it euro yen or dollar yen?
Now, that is the very tricky question because, you know, I do think, although I'm obviously quite excited about the Bank of Japan, you know, at this brink of hiking interest rates, they're going to be very, very moderate, very, very slow in terms of removing this accommodation. In fact, even when they exit negative interest rates, I think you can still call Bank of Japan policy, you know, very accommodative. And I think that's going to be the case for a while. Perhaps we might have a second interest rate hike this year. Perhaps we won't. You know, the economy is still very vulnerable, and the Bank of Japan do not want to remove that policy accommodation too quickly because it would just cut down those green shoots of recovery and perhaps put them back in terms of getting their virtuous cycle on the road. So what we're probably going to see is, yes, we expect some yen appreciation over the next few months, over the next year, but it is probably going to be quite slow against the US dollar. And actually, I think there's a risk that we have, you know, a little bit of backtracking, maybe a sell on the event move if we do get a hike next week, partly because of this simultaneous revision in the market's mind about how quickly the Fed can cut rates.
And Jane, there's a lot of questions actually around the Fed. There's a lot of questions, of course, on gold, something that we were also talking about before, the fact that ETFs were selling off, but maybe central banks were stepping in and buying gold. Is the dollar under threat?
You know, I don't think that the dollar is under threat. So I think if we're talking about, you know, a 30-year or maybe a 50-year perspective, then I think, yeah, things are changing for the dollar in terms of, you know, its status as a reserve currency. That's a very long-term issue. But for now, I don't think the dollar, you know, is under threat. I think, you know, that the fact that the market is adjusting its expectations about the Fed again, I think that's going to be the primary focus for the US dollar. And then we're going to look further into next year. If we get a Republican president, or Trump particularly, are we going to get more tariffs? Is that inflationary? Does that mean that the Fed can't cut interest rates too aggressively into next year? All of these things are potentially dollar positive. If we also get, you know, more of a closed U.S. economy under a Trump presidency, that could be U.S. dollar positive too. You know, less trade flows, that could be more dollar positive. So I don't think the dollar is under threat in the short term, if we define the short term by just the next few years. But if we talk about 50 years, I think we've got a different conversation.
Well, when you look at, you know, the deficit again in the U.S., when do markets start really worrying about it?
Well, you know, I think the deficit for the US is a completely different issue. I think if we were talking about, if you just asked me, when does the market start worrying about the Italian deficit, you know, I think that's probably a different conversation. What we have for the dollar is the dollar, because it's a reserve currency. Well, it's a reserve currency really because it's used so much as an invoicing currency. And that means that the dollar has a slightly different dynamic, even when, you know, negative fundamentals are in the US, there is still this underlying demand for dollars because people need dollars right now to pay their invoices. If you're in emerging markets, you might need dollars to service your debt. So the dollar is slightly removed from US fundamentals in perhaps a way that other countries are not. But I do think that there will be a point when we will start worrying more about debt and deficits. But I think there are probably other countries where the market will be more concerned sooner.
Jane, what's your take on sterling? I know, so we have the MPC meeting next week. Our economists expect a kind of a three-way vote split once again. What does this mean for your expectations for Andrew Bailey and when they start cutting rates?
Well, I think the market's been fairly comfortable for, a few months now that the Bank of England are probably going to lag the ECB and lag the Fed in terms of interest rate cuts. And as long as that sustains, I think sterling can remain this sort of gentle or retain this sort of very gentle appreciation trend that we've seen since late 2022. Of course, late 2022, it was at a very low ebb. That was just after the Liz Truss government. So I think we are slowly recovering. Politics has become quite dull. That is a positive impact for sterling. It means that investors can start to plan, to start to appreciate. I don't think the election's really going to change that much because the fiscal position is so bad that it doesn't give an awful lot of scope for whoever becomes the chancellor after the election, any scope to do very much new. So from that point of view, I think we can see this very slow appreciation of the sterling over, the next year and maybe beyond. But I do think that it is, cable certainly is subject to bouts of dollar strength in perhaps the next 1 to 3 months.
Jane, thank you so much. Jane Foley there, head of FX strategy at Rabobank. Now coming up, elections in Russia begin today with President Putin all but certain to win another term. We look at what this could mean for the Russian economy and relations with the West. That's next, and this is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's nearly a quarter of a century since Vladimir Putin first took power, and his adversaries both inside and outside Russia seem unable to stifle his ambitions, showing off Russia's military might in the lead-up to this weekend's presidential election, which he's sure to win. Now 71, Putin has outlasted world leaders from Angela Merkel to Silvio Berlusconi and held power through 7 British prime ministers and 5 US presidents. In over 2 years since sirens marked Russia's full-scale invasion of Ukraine, Putin's economy continues to weather the impact of retaliatory sanctions, with countries including China, Brazil, and India still buying Russian oil. Riding a rising tide of nationalism, Putin presents himself as a protector of Russian-speaking people. While the death of Alexei Navalny in an Arctic prison removed perhaps Russia's most powerful symbol of resistance. In the years ahead, Putin will have an opportunity to increase Russia's influence in the world, chairing the expanded BRICS group and continuing his friendship with Beijing. Putin. Now, with the war seemingly shifting in his favor, Putin is preparing not only for another term as president, but also possibly for a long confrontation with the West.
Well, that was Bloomberg's Max Ramsey reporting on the Russian presidential election, which, of course, get underway today. Now, the election is a big theme of today's Big Take. I'm joined by Ross Matheson, REMEA News Director, and Bloomberg opinion columnist Mark Champion. So thank you both for joining us. Ross, in what context are voters heading to the polls? And, I mean, it's a given, really, that Vladimir Putin wins it. Does this embolden him in what he does with Ukraine?
Well, it's very easy to say that because there's no political opposition or really public opposition anymore in Russia to Vladimir Putin, he's crushed all of that. There's an easy walkover for him. But he does need turnout to be good, to validate that, you know, the outcome with the Russian people. So he wants to see a lot of people turning out to vote in the coming days, including himself, to get re-elected. But also the underlying that, there's 2 factors that are important to note. One is that the Russian economy is doing pretty well. Wages are rising, you know, especially for lower and middle class Russian people, and so they've got more money to spend. The economy is doing okay because it's on that war footing. And secondly, his rhetoric against the West does resonate a bit at home. He does a lot of rhetoric about how Russia is standing up against the rest of the world, that Russia is under siege from the rest of the world, and he's the one who's making Russia powerful and strong again and standing up against these other countries, and that does resonate again at home with Russian people. So you can imagine, like, in a future Putin term, once he's re-elected, possibly not just once, but another time after that, he's looking at the long term and trying to sort of craft that Russian state really in his own image. And that is about sort of restoring Russian imperialism on the global stage.
Mark, I mean, is there any way of really knowing how much support he has at home?
He has a lot of support. And, you know, this election is a piece of theater. Wasn't always that way. It's been a progression, but at this point, it's a piece of theater, and I'm sure that they will have a number, and that number will be better than previous numbers because he needs it to be. This is a high-stakes moment for him. You know, he chose this war. It's been tough in terms of the number of people who are killed and so on. He'll be very pleased at the moment that he's come out of the you know, what would have been a darker moment. And it looks like he's doing better. Has you know, rallied support. He has crushed his opposition, but he needs to go further. And as Ross was saying, you know, this was always going into Ukraine was always about establishing Russia as a one of the poles of power, able to stand up with China, the U.S., and Europe, and that is still his plan.
But it's really quite remarkable how he, you know, bulletproofed the economy. The fact that actually it's still standing and doing better than expected.
Well, there's always that big debate. Do sanctions actually achieve the desired goal? We can look at history and argue about that. But, you know, he had really, to some extent, sanction-proofed his economy a bit going into the war. This wasn't just a reaction in the minute. Like, he'd built the resilience within the Russian economy ahead of time. And also, he's done a lot of spending, a huge amount of spending in the local economy. He's put it on that war footing. Factories are humming. They're producing a huge amount of artillery and ammunition for the front line. So there's that production aspect of the economy, but also also because of the shortage of manpower, because, as Mark was saying, he's lost a lot of manpower on the battlefield in Ukraine. So shortage of labour equals higher wages for people, and therefore, again, people have more money in their pockets. Domestically on the economy, they're feeling all right. The problem is that all of those things will come to bite down the track. You get inflation, you get a budget hole. At some point, he's going to have to deal with that, but not in the immediate term.
And Mark, I guess it's also, a war of attrition, but also whether the West continues to support Ukraine militarily and with money. Let's first of all listen to what Emmanuel Macron said recently.
Nous avons un objectif.
We have one goal. Russia cannot and must not win this war. For 2 years, we have been helping Ukraine. And if things were to get out of hand, it would only be the responsibility of Russia. If we decide today to be weak, while you face someone that does not have limits, that crossed all the limits that he has told, and we tell him we won't go further than that, we won't be deciding peace, but defeat.
I mean, the French president also, a couple of weeks ago, also floated the idea of possibly sending troops right to Ukraine. If it came to that, and that was met with, horror from a lot of European leaders. Is Europe still together on this?
Well, I think, to give Macron credit, I think he has identified the fact that this is a moment when Europe, the U.S. has kind of stepped aside for the moment. And it is a critical time for Ukraine. Ukraine will fail if it has no ammunition. That is just a simple physical fact. And at the moment, that supply stopped. So it is a critical moment. He's, taking that up. It's a very French position, of course, to say, Europe can act on its own as a strategic player. But he is making that point, and he is also, as an economist, I guess I can say that he's right, because, he's right that if Putin wins, with this sense of, this is all about building himself up as a global power, Russia as a global power, that will affect the Balkans, it will affect Eastern Europe and Central Europe. There is no question. It will bring instability, not necessarily invasion, but instability down the line.
You also wrote a very nice piece, Mark, putting basically we're talking about the hypocrisy between Gaza and Ukraine, or at least what a lot of people on social media are saying is hypocrisy in how the two wars are treated.
Yeah, and it's not just social media. It's also leaders like Anwar Ibrahim of Malaysia, who gave a very powerful speech in Australia. But the point there simply is that there's a kind of whataboutism where you want to make a point about this war, and you have contradictions of your own. For example, Anwar, he does not recognize that Hamas is a terrorist group, treats them as freedom fighters, and so on. And you then start talking about another war, which is actually unrelated, completely different, and try and make these parallels, which actually don't really work.
Roz, Hamas 20 minutes ago says it submitted a new ceasefire proposal to mediators. Is there a real chance of a ceasefire?
It's really hard to see that happening right now. You see Israel just saying repeatedly that they don't believe Hamas is negotiating in good faith. This proposal seems to be incrementally different from the previous ones, but largely the same, asking for about 1,000 Palestinian prisoners in exchange for releasing some of these Israeli hostages, particularly women and children. But fundamentally, there are still questions that remain. Hamas doesn't know where all these hostages are, doesn't know their status. Israel wants to know that before they agree on a ceasefire. Hamas wants to know where the Israeli soldiers would go during a ceasefire. Israel doesn't want to talk about that. It does seem the Israeli War Cabinet will look at this proposal today and discuss it at least, but there doesn't seem to be political will on either side really to reach a ceasefire anytime soon. And meanwhile, Benjamin Netanyahu does say his goal is still to go into Rafah because he believes that Israel still has to achieve its goal here, which is to eradicate Hamas in all of this. And so there does seem to be a little bit of a disconnect in these proposals, but no great way, that we can see it moving forward.
Roz and Mark, thank you so much for joining us. Our EMEA News Director, Roz Matheson, and Bloomberg opinion columnist, Mark Champion. Coming up, we'll also be discussing if Adobe can get investors back on side with its AI ambitions after giving a weak outlook for sales. That is next, and this is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome back now. CMA, CGM, and Merit France have agreed to jointly acquire Altis Media for a total enterprise value of 1.5 billion euros. Now, logistics company CMA, CGM would take 80% and Merit France 20% of the share capital. The deal still needs to be approved. Now, also, in tech, Adobe dropped around 11% post-market and is down pre-market after giving a weak sales outlook fueled by AI competition fears. Now, investors had hoped to see a more positive forecast as Adobe tries to match its rivals through its Firefly products. Well, I'm delighted to be joined by Bloomberg's Charlie Wells, who's all over these U.S. corporate stories. Charlie, so good to speak to you. So Adobe, they now need to convince that AI, their ambitions are on track.
This really is all about Firefly, right? So this is Adobe's generative AI sprinkling that they've put across the Creative Cloud, which is the kind of the suite of software tools that creatives use to edit video, to edit photos. And the problem is that the creatives who use these tools have really been wowed by a lot of these other startup competitors from OpenAI, from Midjourney. And so the issue is this company needs to try to say, look, creators, you can use our tools and deliver. We will give you liability protection, which a lot of these others can't. But they need to communicate that to users and investors.
So talk to me about Samsung in the U.S.
Yes, so Samsung has potentially been granted, this is subject to be finalized, been granted $6 billion from the Commerce Department, and this is a part of the American strategy to try to bring a lot of these semiconductors onto U.S. soil. They've been concentrated in East Asia, in Taiwan, in South Korea, where Samsung is from, so we're also going to be hearing likely over the next couple days, as a part of this 2022 CHIPS Act, a number of these semiconductor companies potentially getting grants and financing, including TSMC, also Intel, which is American.
Charlie, thank you so much for the best roundup, of course, of some of the corporate stories in the U.S. Charlie Wells. Surveillance is ahead, and this is Bloomberg.
look at the number of women that want to learn the game, young girls that are joining on the tee, really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes every...
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stage ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
What's at stake here? Is a sort of risk really that potentially, as you were pointing out, the Bank of Japan doesn't act, and that could cause a massive devaluation of the Japanese yen?
If you missed that special, we'll be putting that out on YouTube, subscription only. It's very expensive. Did you actually watch that? Thank you.
Yeah, it was actually excellent.
You know, people are going to mail in and ask in, there's no special. It didn't happen.
It went 2 a.m. last night.
Let's get to the price action. Equities right now in the S&P 500 looks like this. Equity futures on the S&P positive by 0.2%. Yields are lower by a single basis point. On a 10-year, 427.66. The euro a little stronger, 108.99. One thing that we did see yesterday was the dollar stronger, Lisa, against everything in G10.
Well, honestly, take a look at the flows. I was really blown away by the flows. We saw the highest flows into equities going back to 2021 in the U.S. The flows are all going into the U.S. across the board, whether it's stocks or bonds. This relates to the dollar. Don't worry, I'm getting there.
Sure.
But this, to me, is really the point, is that everyone's buying the U.S. exceptionalism story. Around the world, everyone is plowing their cash into the United States because where else are you going to go? Ultimately, it's heads they win, tails you lose, and that's what everyone's buying into. So, of course, the dollar's going to feel that just a touch as people try to game that out.
DXY just about unchanged this Friday morning. Coming up this hour, looking ahead to the next 60 minutes, John Stolfus of Oppenheimer as another hot inflation print pressures U.S. stocks and bonds. Greg of AGF Investments on Senate Majority Leader Chuck Schumer's scathing comments on the Israeli government, and Marcel Tillion of Capital Economics on growing expectations for the BOJ to hike rates next week. We begin with our top story, another hotter than expected inflation print, pushing out rate cut bets ahead of next week's Fed decision. John Stolfus of Oppenheimer still expecting the end of free money to come to a close, quote, for those of us who began our careers when 10-year Treasury yields, corporate yields, and mortgage rates were at double-digit levels, the phrase none of me thanks, or none for me thanks, comes readily to mind should the Fed cut rates too early. I'm pleased to say that John joins us now. John, we talked about the scent of stagflation. Do you smell the scent of stagflation?
I think it's a little too early to call that, John. I think a couple of hot numbers in terms of hotter than expected numbers in terms of inflation in the process of a Fed funds hike cycle that has been remarkably sensitive to its effects on the economy, just tells us this is part of the bumpiness you get coming out of where we have been, going into a sustainable economic recovery at moderate pace with what is the equivalent of full employment, 3 to 4% unemployment.
There is one takeaway, though, from some of the price action, John, and it's that all the hopes and dreams of a broadening out in the rally seem to die when we have the idea of rate hikes delayed, deferred, or put off indefinitely. Really, that has been the takeaway for me, is that this week when people were worried about fewer rate cuts or even no rate cuts, you saw the equal weight underperform dramatically, the S&P 500. Do you take away something about that in terms of how vulnerable that trade is?
Too short a period to take away, and think that this vulnerability does not exist. It certainly does exist, but at the same time, we're headed in the right direction from what we can tell. And you've got just extraordinary times when it comes to innovation, the resilience that's seen by business in the latest earnings season for the S&P 500 with earnings up close, just under 8% revenue growth, up about 4%, sorry. And with that, 4 sectors, double-digit earnings growth, and not all tech. Things are good. It's just that they're not as great as people would like to see. We're not there yet. We're in the car, but are we there yet? Not yet.
Okay, but you're waiting for the there to happen. You're not waiting for the stagflation to happen. And I guess what's the line between the two? Because ultimately, what we did see yesterday, our minds have to kind of go to the stagflation point. Like John was mentioning, given the fact that we saw inflation come in hotter than expected, retail sales come in lighter than expected. When do we start to get some sort of definitive read on which it is? Is it the strength or is it the slowdown?
It probably comes from a combination of both. It's a combination of the resilience with the slowing, because you've got the Fed, the last 2 years hasn't been on holiday. It's been involved, bringing down the rate of inflation. But inflation is an insidious thing. The other thing I think that we're waiting to see, and it's beginning to happen in food, we've seen it in some aspects in clothing, not really yet in rents, but is competition. Competition, when you go into inflation, originally those who experience high input costs, they eat the inflation and don't pass it on. Then once everybody knows inflation has reared its ugly head, they pass it on to their customers. And then once the Fed does what it's supposed to do and begins to have some significant success, then suddenly those that originally ate the inflation then passed it on, hold on to passing it on for a bit longer so they can make up for the losses at the beginning of the cycle. And then somebody says, hey, you know what, I think I can sacrifice my unit price and maybe make it up in volume. And that is what we're waiting to see. And right now, I think it's a good thing that the consumer, based on those consumer sentiment indices, shows that they are beginning to think genuinely inflation will be here for longer. Indeed, it may be very well, but at the same time, the direction of the growth of inflation is on the way down, and that's where we see the opportunity remains in the equity market.
So as Anne-Marie pointed out, look out for you, Mitch, a little bit later for consumer inflation expectations. John, I want to look ahead to next week. A risk factor in the near term, and you could talk to me about how big a risk this is if that median dot in the Fed projections comes down from 3 to 2. Is that a big deal to you, given that this market has gone from 7 to 3 and equities are still close to all-time highs?
I don't think it's a really big deal. I think it's not just the Fed's heart is in the right place, but the general tone of Fed speak is very much aware of what is going on. It's into this idea, well, they won't say it, but it's going gently into that good night, in this case, in the sense that they are very sensitive to what is the essentially the mandate of the Fed, which is to produce an economy that grows at a sustainable pace without horrible inflation, with manageable rates of inflation. And then when it comes to employment, full employment as defined by somewhere between 3 and 4% unemployment. And it looks like they're doing the job. And I don't think Powell and his Fed want to have a legacy of either cutting too soon or staying at the higher levels where we are now relative to where we were before for too much longer. That said, we continue to think it's a second half of the year when we see the rate cuts happen, and we never expected the 5 to 7 that others were. We always thought it would be likely 1 to 2, perhaps 3, which is what the Fed had initially intimated towards the end of last year.
You've been outspoken about that, John. I just want to finish up by talking about sectors and what you like in the equity market. I know you like cyclicals over defensives. Now, traditionally, defensives would include things like healthcare. Now, healthcare has this GLP-1 element to it, which makes it almost offensive. It's where a lot of money is going in this bull market at the moment. John, what is defensive to you?
Defensive would be consumer staples, the Utes, a significant portion of healthcare outside the weight loss drugs and some of the offsets that come to that, the additional things that come with that related to perhaps what can be done against heart attacks and things like that with the same drugs. But we can't help but think that you want to be in technology, consumer discretionary, industrials, financials, and we're gaining additional exposure to materials here. And it just looks like people are looking at the world and thinking China may be having real problems that it still has to address, but the rest of the world is in a process of normalization where we're in a better situation. We're leaving the emergency status of the world economy, and in that process, moving towards a more stable environment. Now, that doesn't mean anything can happen that would counter that, okay? So you have to be diversified, and you have to know what you own, why you own it, and have right-sized expectations. You can't get too gaga over the market here. You have to be, that's why our target, we're only 1% away from our year-end target now. And people were asking us through most of the first quarter, why don't you raise your target? Well, when we started out in December, we were indicating 13% upside. We just didn't realize how fast we were going to move.
John, to that point, are you going to upgrade your forecast?
We'll have to see. Lisa, I'm looking at all the stuff you're looking at, and John's looking at, and when I think of it, we've got to give it consideration. But I must say, from where we're sitting here today, it would seem like the likelihood of being forced to raise might be necessary after all these bears have suddenly gotten onto the bull case. But some of these guys are talking out of both sides of their mouth, stagflation, but other people within their group saying, oh, it's going to go higher. I don't know. I try to avoid the noise, separate the signal from the noise.
Hey, John, appreciate your time. I think that was a diplomatic way of dancing around that question and answering yes, maybe, perhaps at some point in the next couple of days.
It may be absolutely, definitely possible. I mean, they're only 1% away from the target, and it's not exactly like he's saying that the market's going to crash.
Yeah, 5,200 used to be really bullish. 5,300 used to be super bullish, and 5,400 was just like, whoa, what are these guys on? And here we are now, just around those levels.
So when do we start to get to 5,600, 5,700? I mean, how much of what's underpinning the bullishness is just simply, if things are bad, the Fed's going to cut rates, and they've got a lot of ammunition to do so. If things are good, things are good. And so you can't lose.
That's the challenge this morning. After the CPI and PPI prints we've had in the last couple of months, does it temper their ability to respond to adverse shocks? Negative growth. I think that's the challenge. I'm not saying we're there just yet. I think the base case is still the same. I understand where the consensus is. I just wonder how challenged that view is this morning.
And how underwater this market would be for a stagflationary shock akin to what you're talking about.
Equities right now positive, doing okay, up by 0.2%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Chinese government is calling on electrical vehicle makers, including BYD and Geely, to sharply increase their purchases from local auto chip makers. It's part of a campaign to reduce reliance on Western imports and boost China's domestic semiconductor industry. This follows efforts by the U.S. to curb Chinese chip technology. Copper surging to an 11-month high. It rallied to $9,000 a ton today on bets that a pickup in global manufacturing activity will push up demand for industrial commodities. The metal, seen as a bellwether of the global economy, has surged this week as investors warm to the idea the worst of a global downturn is behind us. And Bitcoin is retreating from its latest record high amid an intensifying debate about whether the bull run in cryptocurrencies has reached a bubble. It reached an all-time high of almost $74,000 earlier this week. Bitcoin and a gauge of the top 100 tokens, which include the likes of Ether, BNB, and Solana, are up about 60% so far this year. That's your Bloomberg Brief. John?
Yahara, thank you. Favorite story of the last 24 hours, Bernie Sanders. If it was up to Bernie, the weekend would have started today. Well, Saturday would be Friday. 32-hour weeks.
It's not a bad idea.
32-hour weeks. You on board?
He knows how to cater to his constituency. Good job, Bernie.
Are you saying his constituency doesn't want to work? Is that what I just heard?
I think so. No. I mean, Bernie Sanders.
Do you want to clarify
hold
those
on
comments for the people of Vermont?
Do you want to work on a Friday?
Absolutely not. Am I his constituency? I'll let you at home answer that. Up next on this program, Schumer reaching his breaking point.
At this critical juncture, I believe a new election is the only way to allow for a healthy and open decision-making process about the future of Israel.
That conversation coming up next, live from New York this morning. Good morning.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Stocks around all-time highs. Equities pushing higher by 0.16%. Pretty phenomenal yesterday to see another hot inflation print in this equity market down not even a third of 1%. Yields have been climbing higher all week, Monday, Tuesday, Wednesday, Thursday. This morning, a little bit lower, down a basis point, 428 on a US 10-year. Under surveillance this morning, Schumer reaching its breaking point.
Prime Minister Netanyahu has lost his way by allowing his political survival to take the precedence over the best interests of Israel. At this critical juncture, I believe a new election is the only way to allow for a healthy and open decision-making process about the future of Israel.
Here's the latest this morning. Senate Majority Leader and longtime ally of Israel, Chuck Schumer, calling for Netanyahu's exit, highlighting tensions in Congress. House Speaker Mike Johnson saying this, quote, "It's just plain wrong for an American leader to play such a divisive role in Israeli politics, while our closest ally in the region is in an existential battle for its very survival." Greg Valliere of AGF Investments joins us now for more. Greg, that was quite an address. Does that help the President of the United States or hurt him?
Well, I've seen this morning, John, reports that the White House cleared the speech. So I have to think the White House thinks it helps them. To be a cynic, which I am most of the time, I think Schumer and the White House realized they could lose the Senate. You know, Larry Hogan running from Maryland, it makes it even tougher for the Democrats to hold on to the Senate. So I think the speech was designed to give cover to people who are critical of Israel, and they can now be even more critical and say, well, Chuck Schumer is as well.
We heard from we got the annual threat assessment this week, and Netanyahu was named in it, talking about his viability as a leader, as well as his governing coalition. So was it appropriate for Schumer to come out and say this, given the fact that this has been widely broadcast already?
Yeah, well, why say what is fairly obvious? I fully agree. And I think that by saying it, he brings out a lot of Republican critics who say, you know, you guys, the Democrats, talk about meddling in our elections, and we're meddling in other people's elections.
Is this a pathway for Congress to talk about strings attached when it comes to Israeli aid?
Yeah, I think that's a great point. So you look, first of all, at Ukraine, and things have started to move. Mike Johnson, the Speaker of the House, has indicated yesterday that he would move a Ukrainian aid bill, but there would be different things tied to it. Maybe it would be a loan. Maybe it would be Lend-Lease. Maybe it wouldn't be the full $60 billion. So I think we've now gotten into the premise that the provisions in an Israeli bill or a Ukrainian bill may get changed.
Well, we've heard loan before. That was what was voted by former President Donald Trump. So we have still that supplemental waiting, as well as the remainder of those appropriation bills to fund the government by March 22nd. Will those bills get done?
I think things are starting to move. Hard to believe, but, you know, we've done 6 of the 12 spending bills, and it looks like of the remaining 6, 5 are almost done. That leaves, obviously, the most contentious one of all. That's Homeland Security, the border, stuff like that. But if we've got now 11 out of the 12, that ain't bad. And I do think that we'll be done well before that April 30th deadline. You know, if they don't get something by April 30th, there's an across-the-board cut, which nobody wants, especially in the defense industry. So I do see some progress now, and once the progress becomes more obvious, they can move on to Ukraine and Israel.
That's where the progress is. I want to just go back to one story that we've been talking about all week, which is the heavy lifting of national security and TikTok and all of the discussion around that. And I just want to get your take, progress maybe on the defense spending and some of these bills. Do you see anything in some of the TikTok proposals that look viable in the near term at all?
Well, we'll see how much money Mnuchin has. He's got a lot of money. I'm not sure he's got enough money to buy TikTok. Maybe John has enough money to buy TikTok. But I would say that's going to be a heavy lift. I don't think Mnuchin alone can do it. He's going to have to put together a consortium. But suddenly the idea of buying TikTok is on the table.
Greg, if I can put together some money, there's a club in the north of Italy that I want to buy. Never mind TikTok. Greg Valliere of AGF Investments. Thank you, Greg. I think TikTok has been really smart about how they've dealt with this. They always frame this as a potential ban. They don't even entertain the other part of the bill that talks about a divestiture, a forced sale. They won't even go there. And they know how that's going to play in this country. A lot of Americans don't like the idea of something being banned, particularly where it's a place where they can express themselves freely. So that's going to play well. Then they talk about commerce, how this is going to hurt business and individuals' livelihoods. Again, that's going to start to play well. They're pretty playing. I have to say, China is very good. I've always thought this. China is very good at playing the game in the West, in the United States. We'll explore everything legally, and they will. This is going to drag out. And then they start to push the buttons in society in a pretty effective way as well.
Well, also when it comes to TikTok, they put a tremendous amount of money behind this in the lobbying camp. $8 million just last year alone. And to your point about a ban, they constantly do this as a tactic. They want Americans to feel, especially the youth that spend 90 minutes a day on this almost, they want them to feel like this is going to be banned. And Senator Warner yesterday, head of that Senate Intel Committee, was on Bloomberg, and he said, we need to make sure this is not a ban. We don't want it to be banned. We want someone to buy it.
I did a sophisticated social survey last night at the dinner table, and it was very successful. And I said to them, you know, how do you feel about the fact that potentially the Chinese government could be seeing what you do? And one of the survey participants said to me that, you know, he felt like it would be ridiculous for him to look at the stupid videos that he watches, and that why would the government care about that? And I said, well, you don't know what the messages are or what else could be thrown in there. And he looked at me like, I'm crazy. And I mean, maybe that's how survey participants are, but I'm just saying that, you know, it doesn't resonate at all.
No, and we know China's position is dripping in hypocrisy, but ultimately, to your point, this is where we are. Equities right now on the S&P 500 positive by 0.2%. Coming up, Marcel Tillion of Capital Economics with expectations growing for the BOJ to hike next week. Live from New York, this is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out. It's about future-proofing our business. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Stocks just about higher on the week this Friday morning. Good morning. Higher again this morning, up by 0.2% on the S&P. On the Nasdaq 100, up by 0.2% as well. If you switch up the board and turn to the bond market, we'll just focus on the front end of the yield curve. The two-year yield, very, very close to 2024 highs in yesterday's session, just short of 470, which is where we were a few weeks ago. But this week, think about where we've been. We've been in the 440s, all the way up to very close to the 470s, up every single day this week, Monday through Thursday, Lisa. Encouraged by the economic data we've seen so far.
So Jim Reed over at Deutsche Bank, who, by the way, has great morning notes, really concise with all of the interesting tidbits from the day, talks about how now we're pricing in the fewest rate cuts of the year. I have to think about it every time, rate cuts, rate hikes. We're going back to rate cuts. 76 basis points now being priced into the market versus the expectation of 158 basis points heading into the beginning of the year. Massive repricing. Where is it? Where is it showing up? Why do people not care on this particular level? And this really ultimately, you raised it well. Stagflation will be the circuit breaker. We're not there yet. But
you set up my next board. This is where it maybe is. Commodities. Brent crude, WTI yesterday, rally. WTI back in the 80s. So we've got crude near the highs of the year. Copper on the London Metal Exchange. Very close to 9K right now, through that level in the last 24 hours. Highest in 11 months. This is what Kaylee Kaminsky of Alpha Simplex said look out for earlier this week. Are we starting to see that emerge in the commodity market?
And it's double-pronged, right? Because on one hand, you're seeing it in the commodity market with the idea of potentially supplies not offsetting some of the increasing demand. But also, you're seeing this where goods have bottomed out. Goods disinflation has bottomed out. So then it's sort of this double whammy. Goods prices increasing as well as commodities pricing.
It also shows the change of the economy and need for some of these goods when you look at the hard metals. Copper is needed for to make chips. This is the semiconductor industry. This is the tech industry. Iron ore, that's to build houses. And that's not doing very well. And a lot of this has to do with China and where that uptick is going to come, that demand's going to come from.
So well said, Anne-Marie. I'd throw in gold as well. Gold, all-time highs in the last couple of weeks. Another one to watch.
Yeah, I can't explain.
Yeah, my jeweler told me, no gold right now. You gotta
Don't
wait,
you think
Anne-Marie.
that gold is part of the copper, part of the crude story, though? Isn't that starting to line up quite nicely? Can we throw in cocoa as well? Maybe we can. Can we throw in cocoa too?
No.
Got a hold of chocolate and gold. It's not good for relationships.
Coming after your gold, coming after your chocolate.
Seriously, happy Valentine's Day. But come on, no. It's so hard to come up with a cohesive narrative for gold. I can't understand it.
Just tried, Bramo. At the surveillance this morning, another hotter than expected inflation print pushing back rate cut bets. Yesterday's PPI data, in addition to CPI earlier this week, helping spur a jump in US yields. Consumer spending showing some signs of weakness in retail sales data, but jobless claims continuing to show strength in the labour market. And I think that's the difficulty for yesterday's data. Let's take out the inflation stuff. Jobless claims, they scream nothing to see here, no problem. Then you look at retail sales first 2 months of this year, and you're like, oh, maybe there's a problem. Which one is it?
Well, I don't know. I mean, honestly, we don't know. And that's part of the problem, is that we're looking into a black void. And the Fed is looking into the same black void and trying to operate. And where do we know the balance of risks? We don't know. It depends on who you ask. And that's what we heard earlier this morning, too, is that people are speaking from both sides of their mouths. John Solfis was good on that. honestly, you take a look at some of the credit card data, it looks pretty good. You look at the retail sales numbers, they don't look great. Is it idiosyncratic? Is it something that's telling? Hard to say.
I'll go back to what Janet Yellen said earlier this week to Fox Business. She said inflation's starting to moderate. Yes, it's coming down. The trend is looking good, but it's going to be bumpy. And that's what we're seeing in this data. It's noisy and it's mixed. I just find it a weird point in the economic cycle where we're at this place where some people are saying, when you say you get confused with cuts or hikes, it's because people have different views on potentially, could there be a hike at this entire year? Jay Powell set us up for a cut.
We'll get a few more of those views a little bit later. Ian Lincoln and BMO coming up very shortly. Look out for that conversation. I want to bring up shares of US Steel this morning. Just briefly, Wednesday we were down by almost 13%. Thursday we were down by more than 6%. The CEO of Cleveland Cliffs raising the possibility of another bid for US Steel. Japan's Nippon Steel offering $55 a share. Cleveland Cliffs considering an offer in the 30s. The renewed discussion coming as President Biden pressures the two sides to keep the company under American ownership. Big story in D.C. yesterday.
Well, Cleveland Cliffs has the backing of POTUS, so why wouldn't you make another offer for a bid? I will go to Wolf Research this morning that says it's unfortunate timing of this deal being brokered. If this wasn't an election year, would this deal go through? Probably. And then you have to think, what was Japanese executives and government thinking of weighing into potentially this massive, iconic American name, and during an election year where both of these individuals, frontrunners, Trump and Biden, talk about bringing manufacturing jobs into the United States? The timing of this, they just read the room completely wrong.
I also wonder what this does to international investment in the U.S. I mean, right now it's not going to have a significant impact. But this is why I go back to this, and I know it sounds really esoteric and no one wants to talk about this on a Friday morning, but there is a question of where national security leaves off and where very politically motivated protectionism picks into play, where you pick winners and you pick losers. You pick who's going to make money and you pick who's going to lose money. You pick Stephen Mnuchin and you throw out other people. And this is really the key question. At what point do you risk muddying the lines of what's real in terms of a concern and what's politically viable?
I agree, particularly in the auto business. I think it's very, very difficult. We're sort of drifting towards central planning in the auto business in the West, and not just in Europe, I think in the United States as well. It was interesting, I saw some comments from the Mercedes CEO where he effectively said, look, we don't want tariffs. We don't want you to block Chinese entrance. And do you know why? Because they've got a big business in China as well. And they don't want it coming back on them because they want to sell Mercedes in China and Mercedes in Europe.
And if you talk to people who actually want to effectuate this transition, get a transition to electric vehicles, they don't mind the idea of price competition because ultimately it's going to be the price-sensitive buyer. How you do this without creating sort of blown-out cities and industries, et cetera, it's a serious issue. But there is a real debate here, and I wonder how much is getting muddied by some of the political postures.
I'll say this, just a final comment, and Anne-Marie, I know you want to jump in. Central planning so far has failed. The market has won because the market is screaming right now, hybrids. And that's where Toyota is and where others that have been pushed by the government to invest huge amounts of money into going towards EV have to face the reality that the timeline, the destination might not have changed, but the time to get there has certainly been lengthened out over the last few months.
Well, this is what John Kerry said to us in Davos. It's not a light switch. This is a transition that is going to take years, if not decades. But going back to China and this idea of what Mercedes had to say, we don't want to be able to be ostracized from the Chinese market. Already we're seeing a tit for tat. Bloomberg scoop overnight. China is urging their EV makers to only use China semiconductors. They want to make sure that they're building their own wall around the Chinese industrial.
They're putting a lot of money into building out that market, that's for sure. I promised the data on this on Japan. If you are just joining us, big story out of Japan. The largest union group announcing the biggest hike in wages in 3 decades. Workers are set to get raises of 5.28% versus the 3.8% expected. The Bank of Japan Governor, Ueda, has cited the wage talks as something to watch ahead of the bank's rate decision on Tuesday. The news fueling speculation the BOJ will raise rates for the first time since 2007. Marcel Tillion of Capital Economics expected a hike next week, and he joins us now. Marcel, great to catch up with you, sir. The yen isn't stronger, it's weaker, and it's been weak through much of this week. And I just wonder, Marcel, is the market starting to pick up on the fact that even if they do move next week for the first time since 2007, this might be it? There's no more moves after that?
I think that was probably known for some time already. I think most of the impact of the yen is probably the yen has been driven over the last year by foreign factors more than by domestic factors. But you're certainly right that this is probably, in our opinion, is going to be a one-off, simply because inflation is coming down, it's trending lower, and this year is probably going to be the high watermark for wage increases. The way the unions operate in Japan is they tend to factor in inflation the previous year, which was very strong, a 30-year high, which is why we're now getting the 30-year high in wage growth. But with inflation now coming down, unions will push for smaller pay hikes next year, and that will take further heat out of the inflation cycle.
Marcel, why is there a different approach to wage growth in Japan compared to wage growth in Europe and the United States? In Europe, it was seen as a problem. In Japan, it's almost seen as the solution, the start of a virtuous cycle of something they've been fighting for a long, long time. Where does that difference in attitude come from?
Well, it relates back to the post-bubble period. I mean, the lost 2 decades, where Japan suffered deflation. I mean, that has left deep scars on corporate executives. A lot of firms had to pay back debt for years, some for decades. So this kind of being constantly in retrenchment mode, trying to cut costs, trying to pay down debt, is just something that has weighed on the psyche of Japanese. I think also on the psyche of households. It's still the case that if you ask households, a lot of households say that their wages are falling, even when they're actually rising. And I don't think it's good for consumer spending and consumer confidence. It's certainly holding back confidence in the economy and maybe also business investment within Japan.
Marcel, how big would the shock be to the dollar yen if the Bank of Japan does not hike rates at next week's meeting?
I don't think there'll be a big shock. I mean, the analyst consensus is still actually that they will wait until April. The argument there is that they will get another Tankan survey, so the quarterly business survey, as well as some reports from the regional BOJ offices across the country that will allow them to judge more the conditions on the ground. I mean, one problem with the wage negotiations is that they only cover 16% of workers, so there's still a question mark about how much are smaller firms which don't participate in those talks, how much are they raising their wages, and that is something that can only be gathered on the ground. There's not much statistical data that allows to answer that question.
Hey, Marcel, great to catch up with you, sir. Thanks for joining us late into the evening in Singapore before your weekend. We appreciate it. Marcel Tillion there of Capital Economics, looking for a rate hike next week. You're on the money with that question. I think it's an important one. There is a risk in the FX market the yen gets away from them if they don't hike next week. Now, maybe it's too soon to say they've got to do it this month, and perhaps they've got time to do it the following month. But Lisa, I think that's what a lot of people are thinking about in foreign exchange.
What we are hearing from note after note, TD Securities coming out this morning and basically saying they're changing their view from an April rate hike to one at next week's meeting. Essentially, they can't ignore the window they're being given. If they do, what does that say, and how much could that roil a yen that's basically banking on this? To me, that's the biggest risk case at this point. It's not them actually making a move.
We'll throw that question to Elsa Linios of RBC. She's up next in just a moment. Equity futures elsewhere on the S&P 500 positive by 0.25%. Let's get you an update on stories this morning. Here is your Bloomberg Brief with Yahara Heckes. Hey, Yahara.
Hi, John. Hamas has proposed what it's calling a comprehensive ceasefire deal in a bid to move forward talks with Israel. Reuters reporting the plan would see the freeing of hostages, including Israeli women, children, the elderly, and those who are ill. This in exchange for the release of up to 1,000 Palestinian prisoners. Israeli Prime Minister Benjamin Netanyahu says the militant group is still making unrealistic demands. The country's war cabinet is expected to discuss the matter today. Voting is underway in Russia in an election that is all but certain to extend Vladimir Putin's rule by 6 more years. It comes as the war in Ukraine enters its 3rd year and amid a crackdown on media and rights groups. Putin is virtually unchallenged, with his political opponents either in jail or in exile. 3 other candidates on the ballot are low-profile politicians from token opposition parties that toe the Kremlin's line. A mishap with the cockpit seat may have been responsible for the mid-air plunge of a LATAM flight earlier this week. The Wall Street Journal reporting a flight attendant serving a meal to the pilot hit a switch on the seat, thrusting the pilot into the controls and pushing down the aircraft's nose. Boeing told the Journal it's in contact with LATAM Airlines and is helping with the investigation. That's your Bloomberg Brief. John?
Yahara, thank you. No. Up next, this week's data making a case for the Fed to push back rate cuts.
We do have forecasts of the PCE. And there, if you look at the core, once again, I see forecasts that reinforce the comments I was making earlier on a steady glide path down to numbers that are closer to their target.
That conversation up next, live from New York. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Tried so hard not to talk about this. I guess we have to. That LATAM flight.
What do you think about it?
That's terrifying. That is absolutely terrifying.
I hope it's terrifying enough to keep people away from booking travel so that the ticket prices go down.
I didn't realize they were still flying the plane when they sat there and ate. I didn't think that was a thing.
You know what I want to know?
I thought they stepped out. There was another seat.
What was the mishap? What happened?
Well, they were saying that she had some food and bumped into the seat and it pushed the buttons. Which can happen. Accidents happen, Bramo. You don't believe them, do you?
You're going to put this on me?
No, I'm just saying.
No, I know.
Just
Look,
trying to work out if you believe them.
People are trying to work out, investigate the button-pushing incident, try to figure out what exactly led to this, how susceptible it is to potentially hitting that button and then going straight down, and then people going straight to the ceiling. We'll have to see.
AMH thinks it was dessert, but, you know.
Could have been a lot of things.
Equities right now up by 0.2% on the S&P 500. In the bond market, yield to lower by a single basis point, 426.46. It's dangerous, seriously.
Oh yeah, big time.
Under surveillance this morning, this week's data making a case for the Fed to push back cuts.
We do have forecasts of the PCE. And there, if you look at the core, once again, I see forecasts, including the Fed's own, that reinforce the comments I was making earlier on a steady glide path down to numbers that are closer to their target. Now, exactly how that proceeds and how they process that in their monetary policy transmission mechanism brain, that's up to them.
Here's the latest, if you followed that. PPI and jobless claim data out supporting signs that inflation may be more persistent than thought, indicating the Fed may delay cutting rates ahead of next week's meeting. Asselinios of RBC Capital Markets writing this. The probability of a March cut remains close to zero. A June cut remains a near certainty, and overall 2024 cut pricing has not moved by much. For dollar to break higher, we'd need to see re-acceleration in inflation and or a bigger non-US risk of shock. Alcelinos joins us now for more. Alsa, fantastic to hear from you. Let's just talk about what we've heard this week and whether it smells like stagflation, particularly the weak retail sales print we got and the hotter than expected PPI. How would you frame that data?
Look, I think if you look at the momentum in the US data and also economic surprises, they've certainly been weaker in recent weeks on the activity side. And then, as you say, on the inflation side, a little bit firmer. It's quite a jump from there to start talking about stagflation. But what I do think is interesting is that we are seeing the market really fundamentally reassess the outlook for Fed cuts for this year. And in fact, we just recently changed our call. We had a June start to the cutting cycle from the summer of last year, and we were looking for the terminal rate to be somewhere in the region of 375. We've now revised that, looking for 3 cuts this year, but it's more about the terminal rate. We're actually looking for something now north of 4%, which I think is the kind of more interesting next story to play for.
That's actually a fascinating story, a neutral rate of 4% or even more. At this point, why is that not being priced into a stronger dollar, especially given the weakness that we're seeing elsewhere?
So I think there's a couple of sides to it. The first is that even though we're seeing weakness elsewhere, there's a very interesting relative productivity story where, because productivity growth has actually been substantially stronger in the US, the wage growth that we're seeing in relative terms is less inflationary than it is perhaps in the euro area, Canada, the UK, elsewhere. So for all that, we do see the Fed cutting 3 times this year, we don't see something radically dissimilar from the ECB or the Bank of England or even Bank of Canada. And I think it's that relative dynamic that keeps the dollar from strengthening material, that coupled with the fact that a lot of investors are already long dollars.
This is a fascinating point, Elsa. I'm still sort of mulling over the idea of a neutral rate north of 4% at a time where you do have people talking about 3 or 3.5% neutral rates, but this is materially higher. The idea that this isn't just a U.S. thing is also fascinating to me. Are you saying that the American exceptionalism story has been overplayed and that globally we have a higher inflation and growth kind of profile going forward than we had pre-pandemic?
I think that's what we're all grappling with. Sell-side analysts, economists, investors, policymakers. We heard Loretta Mester talk about that just last week. She's thinking about raising her long-term dot. And I think it's because we're kind of grappling with how the economy evolves post-pandemic. But I do think there is a difference between the US and the rest of the world. And I come back again to that notion of relative productivity growth, because all else equal, it does suggest that the neutral rate perhaps is a little bit higher in the US than it would be elsewhere if productivity growth is indeed that much stronger.
So, Elsa, what everyone would love in foreign exchange, they'd always love this, that big, fat directional trade and some central bank divergence. Elsa, where can we find that, playing it up against Japan, against something else? Is it Japan versus Europe? How do I play that trade?
I'm surprised not more people have jumped onto that Japan bandwagon, just given we've been here so many times before, and typically sell-side analysts are always looking for dollar-yen to trade a whole lot lower. And in fact, the reaction so far this year has been relatively muted as we get closer and closer to the first BOJ hike. I do think there's a potential for a bit more of a pullback in dollar-yen because the market is fairly heavily positioned in long dollar-yen. But my core view on dollar-yen hasn't really changed, which is that unless you're going to be seeing the Fed materially cutting rates, even a few hikes from the Central Bank of Japan are not going to change the hedging dynamic for domestic Japanese investors. So pull back in dollar-yen perhaps as we get the hike, but that's probably a buying opportunity for a move back up to 150 by the end of the year.
Lisa asked an important question just moments ago. I want to repeat it if I can. Elsa, she asked what would happen to dollar-yen if we didn't get a hike next week. Is there a risk that dollar-yen sort of gets away from the BOJ?
And at this stage, there are a number of people who think maybe they don't go in March, they just end yield curve control, but they go in April. Given the news we've had coming out on the wage front and the emphasis that Japanese officials have placed on wages, it does seem very likely that sooner or later, by the middle of this year, certainly by the time that all the other DM central banks are cutting in June, seems very, very likely Japan will have hiked rates.
So, Elsa, are we talking about a meandering year where there really isn't clear directional trades that shift from what we've been seeing, given the fact that a move by the Bank of Japan, the Fed, ECB and the Fed kind of on the same page? It seems like we're back in this muddle that people have been kind of lamenting for the past couple of months.
Yeah, I mean, it's a pretty depressive outlook for a lot of macro investors, particularly in the FX space. We hosted a macro dinner last night with a number of our large clients, and a lot of us talking about the real decline in FX volatility, the frustration for people kind of looking for big trends, as you say, and just not finding them. It does seem to be an environment that's well suited to carry, you know, so we have seen people piling into some of those high yielding emerging market currencies. From my perspective, I'd still be thinking a little bit more cautiously as to how you fund those, you know, not defaulting to certainly not short dollars or even short yen, short Swiss, but using some other low yielding options, relatively low yielding options like, say, Aussie or even CAD.
So before you go then, what is your favorite trade? What do you really like at the moment?
So it has to be some form of a carry trade. We have been looking at short Aussie MEX for some time, and the carry in MEX still works well, but actually increasingly prefer Brazil over MEX. And again, you know, you'd opt to fund that with a lower yielding commodity currency rather than dollar or euro.
This is a very strong London conversation. Elsa, thank you. Elsa Linios of RBC. Only in London, in foreign exchange, could you have a conversation like that? The thing I'd pick up from the whole thing, 4% terminal rate at the Federal Reserve. I mean, wow. Does the Federal Reserve know about that?
Well, that's what we've been asking. And honestly, this is the key question. Why haven't they shifted up from their presumed 2.5% terminal rate? The whisper is that they are, and they're shifting kind of in their minds to 3 to 3.5% of a neutral rate. But if it's 4 or 4 point something percent, how much does that shift the concept of how much the Fed put really is? Because it's not going to be cutting rates to 0. We're not going to be cutting rates to even 3.5%. That materially shifts some of the investment propositions for bonds that are currently trading at yields that are kind of in and around that level over the next 10, 30 years.
The Federal Reserve decision next Wednesday. It's a three-part story. We'll get a statement, a news conference, and some projections as well. The risk factor, so to speak, for next week. According to many of you, I know, on Wall Street, Ellen Zentner and Morgan Stanley pointing it out, saying it would take just 2 participants to change from 3 cuts to 2 for the median dot to move to a total of 2 cuts in 2024. And regardless of how many you think it is, I think we could all agree on the direction, which is something you've been talking about. And it's fewer, not more, than what you were looking for at the start of the year.
Which is the reason why it's compelling that it's not really taking a toll that much on equity markets or even on credit markets. Does it just matter whether or not they cut? And it doesn't really matter how many times. Is that really valid?
Well, I think back to what Stephen Stanley had to tell us, and again reiterated his call yesterday. He said that he's not going to call victory just yet, but no cuts until after the U.S. election. Steve Rasciuto as well. The Fed wants to cut. The data isn't there.
Stephen Stanley, I find that so interesting. They're going to wait until after the election. No one else is on board with that. And when I hear calls like 100 basis points, they start in June. Well, they're going to cut 100 basis points going into the US election later this year. That's quite a call.
You know, I'm struggling with all of the Fed prognostications because, again, that crystal ball is looking like it's cracked and cloudy and very difficult for everybody. They don't know. They want to cut. And the problem is the data's not cooperating.
June just feels stale and highly convenient because it's kind of near enough to say we still expect rate cuts and not much just changed, but it's far enough out to say that things are going to change between now and then and that will give the face to cut interest rates. It just feels really stale based on the data we've seen so far this year.
I love that. You said that yesterday. I thought it was absolutely bang on, that basically we're dealing with people who are just trying to push out the timeline before they get some conviction. And right now we're not getting any conviction. We've got a lot of bored traders.
We had to change our views so many times every single month last year. It's like we'll just stick with our view, push it out, extend the timeline. And in June, everything's going to change. Coming up next, Sarah Hunt of Alpine Saxon Woods, Michael Shepard of Bloomberg News, Dan Ives of Wedbush, Ian Lingen of BMO Capital Markets, the second hour of Bloomberg Surveillance, up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother.
at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
To keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
If the Fed starts to materially push back on rate cuts, I think that's when you start to have to worry.
We initially thought the first rate cut would come in May. That's kind of off the table, more or less, at this point. We've pushed that back to June.
They could start in June, July, and they'll have more data in hand by then. They are not in a rush.
You can live with slightly less easing by the Fed if it's happening in the context of a strong economy and strong earnings.
We are not in a recession nor on the edge of it. And we don't see the normal indicators yet that would suggest a meaningfully weakening economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The stock market up on a session, up on a week. Equity futures positive by 0.2%. The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. We are closing out the week very close to all-time highs and looking ahead to next week. This week's data was always about how it sets up next week's Fed meeting, and it's inflation dominating the conversation again.
In all the wrong ways. And so this is really going to be the key. How does the Fed face off with two inflation reads back to back that came in hotter than expected, with this idea that growth, while strong on the margins, may be slowing? Maybe not stagflation, but getting to an area that's less comfortable. Do they deal with it with the dots? Do they deal with it with anything? Do they give any signal whatsoever? Or do they just back off and say, do what you do, we do what we do, we've been right?
They have the luxury of time, maybe, and we've said this a few times on this program. The economic data in certain places seems to be in conflict. Yesterday was a fantastic example of that. Jobless claims just said, jobs market solid, decent, nothing to see here. Retail sales, second month of weak retail sales. Mohamed El-Erian a week ago today said there was something in that payrolls report for everybody. It was ambiguous. There was something in that data yesterday for everybody.
Oh, for sure. Across the board, when it comes to the data, you can extrapolate and decide which way that fits with your thesis. The Fed meets next week, but more interesting is what they have to wait for. Maybe this gives them an easy excuse. This isn't the inflation indicator we look at. We need to wait for PCE. So for me, it's going to be about the end of the month, March 29th. What does the PCE say? And Ian Shepardson is basically saying the core PCE advancing 0.4%. When rounded, that's basically January's print.
Well, to me, and you're right, my issue is there is one conclusive point that you can take from all the data. inflation's stickier than many people wanted. And inflation's multifaceted. It's not just coming from services, now it's also coming from goods, which hadn't been the case for a very long time. How much are we looking at some sort of reinflation coming from commodities, as you pointed out earlier, John, and also from this idea that people are shifting back to buying stuff after, kind of boycotting it for the services for a while?
Let's go through commodities. I'll list 3 of them. Copper, back through 9K, a little bit earlier. Back through 9K, highest in 11 months. Crude, back in the 80s in the last 24 hours, highs of the year. Gold, in the last week or so, all-time highs on gold. You look across the commodity market, starting to see it across the board.
Yeah, you're starting to see an uptick. Actually, that is why the University of Michigan sentiment last month, which we're going to get today, you saw people have their sentiment start to crack because likely higher gasoline prices. What you're seeing is oil, is the IEA, though, came out and they see a supply deficit through 2024. OPEC is still holding back on some of these cuts. At some point, they're going to have to come in with a little bit more supply.
Did you get the call from you, Mitch? Yeah. Still waiting for the call. Where do you see inflation in 5 years?
I'm going to prank you tonight. Like,
you're going to call me?
Jonathan Farrow.
12%.
What do you think?
Why are you doing an English accent?
No, maybe they're trying to tailor it.
I'm not sure that's going to fool
you don't
me.
think so?
No.
Hello, I'm calling from the University of Michigan survey.
No.
What do you think?
I'm going to still answer. I'd play along with you, just to practice. Okay. Equities right now on the S&P 500, positive by 0.2% on the S&P. I really still don't know what I think about that data, but
I know, but we do it anyway.
Sure. In the bond market, yields lower by a single basis point, 427.66. Do you remember the Fed made a move on you, Mitch? That was like sealed the deal.
Oh, yeah, because it was basically expectations for inflation picking up.
Isn't that when they messaged WikiLeaks over at the Wall Street Journal and said we're going to do an emergency hike?
Yeah, exactly. Although I will say, expect something surprising this particular read, because typically it tracks oil prices pretty closely, gasoline prices, and gasoline prices have been going up. So expect some deterioration there.
And in the last month, individuals, part of the survey, saw inflation 3%. That was up from January of 2.9%. So it's tiny, but people's expectations of inflation are rising.
You, Mitch, 3 hours away. Equities right now on the S&P firmer by 0.2%. Coming up this hour, Sarah Hunt of Alpine Saxon Woods as another hotter than expected inflation print pushes out rate cut bets. Dan Ives of Wedbush ahead of NVIDIA's AI conference, and Ian Lingen of BMO on why he sees hints of stagflation. Looking forward to that. We begin with our top story. Treasuries holding steady after selling off on the heels of another hotter than expected inflation print. 10-year yields on pace for their biggest weekly rise since October as investors push out rate cut estimates ahead of next week's Fed meeting. Sarah Hunt of Alpine Saxon Woods writing this: there is a tension between the idea that not cutting rates means financial conditions will passively tighten if inflation continues to wend its way lower, and concerns that when there's enough liquidity, the conditions are still too loose. Sarah, I'm pleased to say, joins us now. Sarah, what do you think of that data? PPI, upside surprise. CPI, upside surprise. How does it change next week's Fed meeting?
It's going to be interesting because I agree with the guests that you've had on earlier and what you guys have been talking about. The Fed wants to cut, right? They're looking for an excuse to cut because they don't want to get to the point where they're passively tightening as opposed to, they don't want that to happen. But I think that this data does not give them any help in that. They could just sort of ignore it and say, well, yes, we're looking at other things, to your point, Anne Marie, that, we're going to look for the PCE, we're not using this. But I think that it makes it a little bit tougher for them to do it on the time frame that they were looking at. If this had been a more benign number, I think you would have seen that May call come back. And I don't think anyone was looking for anything in March. So they may just not say a whole lot about it, but we'll see. It's going to be interesting to see what they say.
Should jobless claims make them comfortable, or should retail sales make them uncomfortable?
Yes.
Yes to both?
Yes to both. And that's the problem, right? Because we keep getting these different pieces. The labor market has stayed stronger. In December when they pivoted, one of the things that Chair Powell said was, we now see the risks as being balanced between inflation and the labor market, whereas before that, everybody was like, they're going to try to kill the labor market. So I think that the fact that we are seeing still good labor, they really don't want to put the country into a bad labor market. They don't want to do that. So that's going to be helpful, but it's just, the other data was just not that great.
It strikes me in some of my conversations that just hypothetically, some people might be very bored with the muddle because it's been the muddle for quite a while. What does a bored trader do, given the fact that we've got a lot of them?
Well, they probably take out too many leveraged bets that come back to bite them. I don't know. This is the problem of having the non-directional. You were asking earlier on the FX trade, like someone's looking for a big directional trade. We have these little incremental moves where the moves are incremental, but the zeitgeist swings from, oh my God, we're going into a recession, to, oh, the economy is so great, we don't have to cut rates. I mean, there's been a lot of moving back and forth, but it's the same, from the same two places. And that does tend to get people, you know, you can't quite figure out what's going on. If people are not worried about rate cuts being pushed out because the economy is good, well, that's great for the market. If they're worried that they're getting pushed out because inflation is bad, that's bad for the market.
People are so spoiled. The fact that people are bored. We've just had an all-time high in Japan, haven't seen one since 1989. We've had records in Europe, records stateside. We've got two huge bull markets taking place, one in AI, another in GLP-1s. I understand that they want more. We always want more.
Okay.
But seriously, some of the levels we've hit in the last few months have been pretty incredible.
Yeah, but they haven't been a straight shot up. It's been basically and it hasn't been with any conviction.
In February alone, yes, we had two of the biggest single-day market cap gains on single names in the history of this stock market.
But has it been because people are just plowing in and just so excited and looking for that upside surprise, or is it because basically it's just been the story that keeps on giving? You've won by not shifting around your portfolio at all, which is hard to do.
That's why they're bored, because they're waiting for the rotation that hasn't developed in the way they wish it was. I mean, we caught up with SIBO and Mandy Zhu earlier this week, and she said they're positioning upside bias, and we're like, on what? Small caps, right? They're bored because the same things keep winning. Should they start to get used to the same things winning all the time, or is that going to change sometime soon?
Well, there's also the issue of, you know, the same things are winning, but that then echoes a lot of other market bubbles, and people start worrying about a market bubble too. So there's that problem as well. I think to the extent that the AI stocks are winning, they're really making money. There's actual cash flow there. This isn't a group of stocks that is running on a promise, right? It's running on some actual results. So there's that. So I think that it stays sticky. But on the other side, there is some concern that you're seeing these big run-ups in things like the GLP. But there's real money there. But then what happens to the rest of the market? And there's a lot of parts of the market that haven't been participating.
Including energy to some degree. And I know that you were bullish in energy and then you pulled back a bit. We're seeing this going back to November, and this idea that maybe supply can't keep up finally with demand after a pretty strong run. Have you shifted your view on energy?
Well, to your point also earlier, there is still excess supply out there, right? Because there's still being oil held off the market. The question is, it's moved up, and it's moved up in a quiet way. So the stocks haven't really caught up. So there's value in that trade right now. The question becomes, does this problem that's going on with transportation, because it's still a problem, they're still seeing that issue going through, does that change? Because if it doesn't change, then you can see tighter markets, and you're seeing them right now. And that move up hasn't been a convulsive move up. It's been like that incremental, you know, itsy-bitsy spider move up. So
it's kind of crazy that we're all excited potentially about a Brent crude move in the 80s, and there is literally a hot war in the Middle East, and you have Houthis still striking vessels through the Red Sea and the Gulf of Aden. I mean, how high could you see oil prices actually go, though?
Well, I think, so right now you've seen the problem that's causing, which is higher transportation costs and longer transportation times. But it hasn't hit production. It hasn't hit something like right now that's staying within a framework that is not problematic for the fields themselves. It's problematic for transportation. If that changes, I think you could see bigger moves, because then you don't know where the supply is going to come from. Right now, supply is not so much the issue.
Speaking of boredom, you bored of politics yet? 8 months out from the election.
Longest election in our lives.
It's a long one, isn't it?
It's been going on for 3 years, and it's just going to go on for one more year.
The fact that it's decided so early this year as well, not even getting a proper primary, it just feels sort of so anticlimactic. We end up with the same two candidates.
It's going to be so expensive because these people have to campaign earlier on, especially the former president. He was in court yesterday. He's got to pay for legal bills.
Lisa, comparing the race for VP to The Bachelor, is that what it feels like to you?
Yes. I mean, we're floating lots of names who potentially have other, different attributes. He's a billionaire too.
I can see why you're bored of that.
Well, not when you got Kristi Noem, the governor, coming out with hit after hit of videos.
What is going on with Governor Kristi Noem of South Dakota? What is happening with her Twitter account?
I'm not sure, but she seems to be doing what feels like infomercials. And she's going to face some lawsuits
because of this.
Have you seen
the latest one? Inserts for shoes. She's celebrating inserts for shoes. I've got no idea what's going on there.
Well, look, you know how I feel.
A dentist in Texas yesterday.
Okay.
Day before.
Gotta have a nice smile if you're running for VP.
The fact that we're talking about this and not the deficit and not other things that are very real, to
me,
is
Lisa,
frustrating.
Debbie Downer Friday.
Okay, but you know what? You can say that. But on the flip side, this sort of anxiety underpinning some of the commentary is not wrong if you just look at the math. So at a certain point, It's fine to talk about inserts and dentists and to talk about, bachelor type runnings, but where is the policy discussion that I'm looking for? And yes, I will be a double Debbie Downer on this.
For those of you watching The Bachelor, I think Joey should have kept Maria. Okay, Sarah, you're going to stick with us. Sarah Hunter, Valentine Saxon. If you know, you know. Okay, let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. Someone somewhere loved that with Yahira Hackers. Hey, Yahira.
Hi, John. Voting is underway in Russia in an election that is all but certain to extend Vladimir Putin's rule by 6 more years. It comes as the war in Ukraine enters its 3rd year and amid a crackdown on media and rights groups. Putin is virtually unchallenged, with his political opponents either in jail or in exile. 3 other candidates on the ballot are low-profile politicians from token opposition parties that toe the Kremlin's line. Shares of Adobe are falling in the pre-market after posting a weak sales outlook. The guidance is fueling concerns new AI-focused startups are threatening its market share. The company has been integrating its proprietary AI model Firefly into its top products such as Photoshop and Illustrator. Still, a recent demonstration by OpenAI of its video generation model Sora is fueling concerns about competition. A mid-air plunge during a LATAM flight earlier this week may have been caused by a mishap in the cockpit. The Wall Street Journal reporting that a flight attendant serving a meal to the pilot hit a switch on the seat, plunging the pilot into the controls and pushing the aircraft's nose down. Boeing told the Journal it's in contact with LATAM Airlines and is helping with the investigation. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, the TikTok bill stalling in the Senate.
Nobody's talking about a ban. We're talking about transferring the ownership and the algorithm to some other control that's not Chinese.
TikTok is talking about a ban. It's the difference right now on Capitol Hill. That conversation up next.
Sarah, you on TikTok?
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
S&P 500 futures positive by 0.2%, yields lower by a single basis point. The state of affairs this morning. Here's a snapshot of the market for you. Your 10-year yield very close to 430, 426.46. Under surveillance this morning, the TikTok bill stalling in the Senate.
But I think we need to get this done. And what again we need to make clear is nobody's talking about a ban. We're talking about transferring the ownership and the algorithm to some other control that's not Chinese.
Here's the latest this morning. The TikTok bill facing division in the Senate. Lawmakers walking back the idea of fast-tracking legislation that would force the app's parent company to sell it or face a ban. Democrat Richard Blumenthal warning the deadline to sell or shut down is too short, while Republican Ted Cruz saying the measure should face a full amendment process. Michael Shepard of Bloomberg joins us now in D.C. for more. Shep, how long is this going to take? Just a whole lot longer than we thought it would.
Well, John, it could take a while. Now, when we heard the words regular order early this week coming from senators' mouths, that signaled that they were going to put this through all the paces. That includes putting it to committee, subjecting it to hearings and amendments, and a lot of intensive review, essentially rewriting it and then having to send it back to the House. Now, remember, a little bit more than a week ago, this thing was still below the surface. And the House went from 0 to 60 in almost record time. Now we're seeing the Senate slam the brakes on. They really want to proceed carefully because they also understand the consequences. This app has 170 million users nationwide, and there could be more at stake too, especially with relations with China.
Well, the FT also has exclusive reporting that it now has hit $16 billion in sales in the U.S. A lot of money is at stake here for ByteDance. What narrative is winning in Washington, though, Shep? Is it a ban or a rebrand?
Well, the word that people are settling on is actually divestiture. They really would like to see the app itself. Most lawmakers would like to see the app itself survive, but without this tie and ownership related to China. They really wanted to see it emerge as a standalone American presence, separated from the Chinese parent company, ByteDance. But that is where the things get very difficult because the Chinese government has expressed some misgivings over this whole process. They think the U.S. government is barging in on private commerce in a way that it shouldn't. And they're also concerned that giving up some of the crown jewels of the company, including the algorithm, could hurt ByteDance.
Overnight, China is urging EV makers to buy local chips. This is as the U.S. clash continues to deepen. Is this the trajectory regardless of Trump or Biden in the White House?
Well, Biden has really picked up the torch where Trump left off with China. He has not taken his foot off the gas when it comes to trying to contest China, the world's second largest economy, on a range of fronts. And you brought up EVs and chips, these emerging technologies. That's another one. And the current president has really put a heavy amount of focus on the question of chips and chip-making technology, seeking to restrict exports to China of some of the most exclusive and sensitive chip-making gear, for example.
Shep, bureaucrats in Washington talk about national security. The former president just calls it America first. Shep, what's the difference ultimately in terms of policy? I understand the difference in the rhetoric, but what's the difference in the policy that you're seeing from this administration and the last one?
Well, it's a good question. The America First of Donald Trump is a little bit more isolationist, and it really is one where, we see a little bit more of a retreat in terms of those expansive global commitments. Now, one of the differences with Joe Biden, though, is that it is really mindful of those core constituencies. We saw him paying, a great deal of attention to the steel workers, for instance, in this attempt by Nippon Steel to buy U.S. steel. And that is, I guess, one way to brand it a little bit differently. But at its core, there is a fair amount of overlap. They are each trying to build American manufacturing and trying to shore up U.S. economic prowess, even if it's at the expense of some of the global relationships that we have built over the years in terms of commerce.
Shep, at times it feels like he's speaking directly to the people of Pennsylvania, Michigan, Wisconsin. Do they understand the language of Washington? Is that resonating at all?
Well, the important thing is for Biden to speak their language, too. And he really has made an effort to do that with these visits. And he has tried to forge those relationships with the unions. And remember, Joe Biden is a child of Pennsylvania. He was born in Scranton. He will remind you again and again of his roots, of his heritage there. So you see how that plays out. Now, whether people are listening, whether people are buying the economic message also depends on how they're feeling it at home. Biden can say one thing, but are they seeing it in their communities? Are they feeling it in their pocketbooks? And so far with our Bloomberg Morning Consult poll in the swing states, they are giving the edge to Trump when it comes to handling the economy.
See that repeatedly. Shep, it's great to catch up with you down in Washington. Michael Shepard there of Bloomberg on the latest stories dominating the nation's capital. Sarah Hunt is back with us. Sarah, we've got these two risk events on the calendar. The Federal Reserve in June, because that's when this rate cut's going to happen now. Most people agree. And then you've got this election in November. And people just sort of look at it in the calendar and say, it's out there somewhere. I don't need to think about it right now. Do they need to think about it right now?
I think the difficult thing is that there is such a long period of time and that there's this expectation that any number of things could happen, and so that it's hard for anyone to pin it down, and that any changes either on the global stage or other places could shift things one way or the other. So deciding today what you think the outcome is going to be and acting on that is quite difficult. I think with the Fed, there is that expectation that we're going to get some rate cuts, but as those dial back, it's not the same as saying, we were going to be down 200 basis points, right? And that was going to change everything, and that's okay, and that's great for tech stocks, and it's great for all sorts of things. But on the other hand, the fact that you're getting interest on cash is a good thing too. So where the Fed goes ultimately is going to be a big deal, and that keeps shifting around too. We keep hearing now north of 3.5%, maybe it's 4%. There's a lot of change that's been going on with both of those things. So it's hard to say, yes, let's make a plan, and let's make a plan on the basis of this X going this way.
Michael Shepard was just talking about how either way, whoever wins, there is going to be this emphasis on trying to protect the U.S. security, to protect U.S. workers from some of the international competition. Does that feature in what you decide to buy, what you think might be susceptible to national security claims and real kind of interference on that level?
I think that really shifted from the beginning of the pandemic even to now, because the move was, for whatever reasons you want to call it, was either home shoring or onshoring or friend shoring, or however you want to, whatever terminology you want to use, that says, I need to make sure that I have a decent line of sight into my supply chain wherever it is, because we've had transportation issues before. We're now seeing this issue in the Red Sea. There's all sorts of things on the international stage, and or somebody who was an ally could become less of an ally, and then all of a sudden they're going to threaten not to give me the things that I need. So I think that that was already happening, and I don't think that either side of the aisle right now is pushing in the opposite direction. So I think that directionally that's going to continue.
Has it happened? Because a lot of people say that it actually hasn't happened, and the whole nearshoring and friendshoring was sort of a lot of lip service that didn't really come to fruition. Do you buy this story that we're in the process that is going to be naturally inflationary, that's going to build in redundancies, that's going to have legs?
I think that it's not happening for a variety of reasons. There's a number of stories about the CHIPS Act, about why that money isn't going places, and there's too many regulations and restrictions on that. But I think from a standpoint of, I'm a corporate CEO, I want to make sure I know where my things are coming from. Is it going to be a chip plant in the U.S.? At some point, probably. But in the scheme of things, I'm going to be much more attuned to that than I was before, regardless of who ends up in the White House.
How does the U.S. talk about friendshoring when they want to block a deal from a friendly ally?
That is a difficult question to answer, and I did not block that deal, so I cannot answer it.
No, but how do you prepare for that? It's almost impossible.
I agree. It's such a good question. Sarah Hunt of Empire Saxon Words. We've seen this repeatedly. We're dressing things up in language that might be palatable for our allies, but ultimately look at the action. Don't listen to the words. This is the difference between former president talks about America first, starts talking about America first. Everyone's like, whoa, America first. What's this about? Tariffs on China. How dare he? And then here we are. Same policies dressed up in very different language, but ultimately same thing.
National security in the Wall Street Journal editorial review this morning calls it self-destruction. And they say regardless of Trump or Biden, it's going to be a nasty election, but there's going to be policy damage because of it.
Coming up on this program, we'll catch up with Wedbush. They're raising the price target on NVIDIA to $1,000. That conversation up next with Dan Ives. We're not just going to talk about NVIDIA. We're going to talk about Tesla as well, because Tesla has had quite a week again, a difficult week. Just what is going on with EVs? The big focus right now is on hybrids. And according to Morgan Stanley and Adam Jonas, maybe the old school Detroit 3 might be the winners of this mess stateside. That conversation's coming up shortly. Equity futures on the S&P 500, positive by 0.2%. Bond yields just a little bit lower on the session. On the week, a whole lot higher. From New York, this is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Commercial break just dominated by Dan Ives talking about Formula One, doing anything to get away from talking about Tesla. We're going to talk about F1 or Tesla?
We could talk about both.
Okay, both. All right, sprinkle of F1. Equity futures right now on the S&P 500 positive by 0.2%. Equities with a lift on the Nasdaq 100 higher by 0.16%. Higher all week in the bond market. 2-year up Monday, Tuesday, Wednesday, Thursday. Friday, just a little bit lower, 468.94. We've gone from the 440s, very close to getting back into the 470s going into next week. And that move, backed up by the data, PPI hot, CPI hot, the Fed on deck, Lisa, next week.
And really, to me, the call of the morning so far is Elsa Linios, not just talking about fewer rate cuts this year. She sees 3, pretty much in line with the consensus, but says that we're going to have a neutral rate north of 4%. That means that the Fed will stop very soon after starting with their rate cuts, and that this is a very different economy that can handle a very different benchmark rate. Have stocks woken up to that? Has credit woken up to that? I think it's a valid question.
Commodities, are they waking up to that inflation story? There is an inflationary feel to this commodity market today. Copper on the LME in London on the metal exchange through 9K. We're talking about 11-month highs there. We're talking about 2024 highs in the crude market. Brent crude just short of that level right now, $85, $80, very close to 81 on WTI. We're negative 0.6% there. So we've got basically year-to-date highs on crude, 11-month highs on copper, close to all-time highs on gold.
Well, when I look at the metal market, though, and I spoke about this earlier, copper and iron ore, you're seeing the divergence of these two metals, and that is because China and what they're going to be spending their money on when it comes to the commodity market. They need copper for the technological industry. They don't need iron ore as much what they would need for the property market. When it comes to oil, you got to look what the IEA has come out and said, basically flip-flopped on where they see supply and demand. And if OPEC decides to keep that supply on side, then prices are going to go higher. But it's amazing prices are higher now, even though we've had 2 hot wars.
It took a while to get here, Bramo. We talked about it since the start of October, just what is going on with crude. The curious case of crude, the fact that it didn't rally in the back end of last year.
The curious case of the United States pumping oil at a record pace, and that's really been the story. So, you know, do we see cutbacks? How much will OPEC Plus offset some of the supply from the U.S.? Either way, bottom line is the strength hasn't died off, and I think that that is the underlying.
Sarah Hunt's point earlier was smart, though. The fact that supply actually hasn't been hit, it's just the fact that transportation has been hit. But for OPEC to come into this market, it might get political. This is what happened ahead of the midterm elections. Prices got much higher, huge spat between Washington and Riyadh, because the Saudis said, we're not going to help you out ahead of this midterm.
We haven't talked about the strategic midterm reserve for a while, have we? 85 on Brent crude, 84.95. Under surveillance this morning, Senate Majority Leader Chuck Schumer calling for new elections in Israel, saying current Prime Minister Benjamin Netanyahu has, quote, lost his way. Schumer saying Netanyahu made a, quote, grave mistake rejecting a 2-state solution, and a single state controlled by Israel guarantees certain war forever. Republicans critical of Schumer's comments. Senate Minority Leader Mitch McConnell calling it hypocritical for an American to call for the removal of a democratically elected leader. And and not just a democratically elected leader, but one of the major allies of the United States.
Yeah, and the biggest ally when it comes to the Middle East. And we heard from the ambassador of Israel to the United States saying Israel's a sovereign democracy, calling it unhelpful. But what Senate Majority Leader Chuck Schumer said yesterday is what people tell me off record. They are unhappy with Netanyahu. He said the quiet part out loud, but that leaves the path open for other Democrats, and I'm not just talking about ones on the progressive left, other Democrats to come out and be more critical of Israel.
That's the latest in Washington. Here's the latest in China. China quietly asking its EV makers to sharply increase purchases from local chip makers as part of a move to reduce reliance on Western imports. Bloomberg reporting China had asked automakers to source a fifth of their chips locally by 2025, but has grown dissatisfied with the pace of progress on that front and is now directly instructing firms to avoid foreign semiconductors if at all possible. That's led to some foreign brands losing out on contracts despite offering prices that were as much as 30% lower, Lisa, than domestic names.
This is going to become an increasing focus, right? How much are U.S. companies going to get hurt from the tit for tat with China, given the fact that there is this increasingly protectionist approach by the United States, and that there will inevitably be a response from China, if not what they already were planning on doing. So at what point do you start getting pushback from some of the tech giants, and at what point do you see it priced in more significantly?
U.S. officials for a year, a better half of a year, have been talking about we want to diversify. We don't want to decouple. This looks like the start of serious decoupling.
A good friend, Dan Ives, is here of Wedbush. And Dan, I'm going to do a TK and rip up the script. We're not going to talk about NVIDIA right now, and I'm sorry if they told you we were. This is about Tesla. We'll get to NVIDIA in just a moment. Wells Fargo came on the program yesterday. This is what they had to say. No growth this year, negative volume growth next year. How do you value a company if they're going to be the growth figures over the next 2 years?
Yeah, look, I disagree with next year in terms of the negative volume. I mean, like, my view on Tesla is it's easy right now to get negative. Look, they are going, I mean, we talk about it day after earnings here, they're going through a white knuckle period. I mean, China demand's been soft, the margin story, the communication. But look, my view is on the other side of this will be a company on its way 2.5, 3 million units when we look at the next few years. They will gain more share, the leverage will be there, and I believe ultimately numbers, EPS growth will start to come back up.
It just doesn't feel like that's where the market is right now. It feels like the market is in a space which benefits hybrids, Toyota, GM starting to lean in that direction. Think about it, Ford's already there. Tesla just doesn't feel like it's in the sweet spot. What's going to change your mind on this?
Well, I think the issue is, do you want an EV or do you want a Tesla or do you want a hybrid? And I think for Tesla, look, a lot of it comes down to price. And obviously they've cut price. That's what they need to do in terms strategically. The problem now, and speaking to Wells and some others, is that numbers have come down. It's going to be a sluggish 1Q. So in the near term, it is easy to be negative on this. I mean, our view is, look, we've been here before. The last decade, many times we've been in these white knuckle periods. To me, this is not the end of the growth story. I believe this is a growth story with AI, FSD, that's still going to have a significant piece on the horizon. But no doubt, in the near term, like when I have a positive note on Tesla, probably 30 emails within 10 minutes negative, because sentiment, I mean, look, the Uber driver today was super negative on Tesla.
Yeah, but Dan, you know why they're upset. Because if I'm a client, this stock is down by something like 30% year to date, and you've had a buy on it the whole way down.
No doubt. But
that's why they're upset.
100%. But in my career, in 25 years, our calls have been when things got the worst, whether it was Apple, Tesla, Amazon, Apple, when things got the worst, you handheld through those periods in terms of onto the other side. It is easy to yell fire in a crowded theater when you're going through this period.
It feels, though, like it's not quite yelling fire when it comes to things like pricing in what we were just talking about with China and this risk of a real pushback against American-made goods. Have you factored that into a bullish thesis for Tesla, saying that demand from elsewhere can really overcome a lack of sales in China potentially?
Well, 20% of demand is essentially evaporated if you look at China. And I think that's been factored into name. Just got back from the region, this week. Look, it's as negative as I've seen in China, Hong Kong, the broader region, because of this Game of Thrones price war that's going on. And it's the domestic versus Tesla. And you look at BYD and others. Look, I think this is not necessarily mutually exclusive. I think you could have many winners here. But I will say, this is definitely, from a Tesla perspective, not just from a sentiment, but probably some of the nervous period that I've seen in 4 or 5 years.
Well, I want to extrapolate broader than that to talk about some of the other tech giants as well, because we're seeing the sort of question mark of what other China exposure is there to, say, NVIDIA, to Microsoft, to Meta even, with respect to advertising in China, as we do get more exposed to a sort of tit for tat, as you say, Game of Thrones price war. How do you price that? And how do you understand if it's being priced at all into the market?
Look, part of why, in terms of the Mag 7 right now, at that party, Apple, Tesla, they're knocking on the door saying, let us back in. Because part of the problem is it's the China exposure. When you look at the godfather of AI, Jensen and NVIDIA, and we'll see it on Monday, right now it's their world, everyone else is paying rent. You look at Microsoft in terms of Copilot and AI, you look at the other tech giants that really have no China exposure. That's why what's been the sort of magic carpet ride in terms of what's been the tailwind now is a headwind in terms of China for Cook and for Musk. And even when you look at the TikTok, in terms of touching the third rail issue, okay, for Meta, for Google, that's not an issue. But for Apple, for Tesla, they're the ones that have the bullseye in the back in terms of what happens domestically within China.
Does it matter if China's urging these EV makers to use homegrown companies instead for NVIDIA, for the likes of NVIDIA and some of these other companies?
Yeah, I mean, look, NVIDIA, we're talking about the gold standard. In other words, the reality is they're the only game in town. So China could do that. For the next 2-3 years, there's really no alternative. That's why Jensen ultimately is sitting there. They built it, everyone's coming. Now, longer term, you talk about the coupling and what's happening here. It's definitely, look, we're starting to go down. That cold tech war feels like it's taken another turn, but it speaks to our view with TikTok and what we're seeing in terms of on the Beltway. It's great for political theater in front of the microphones. The reality is the ripple effect here is important in terms of what it can mean for China, U.S. And the reality is that selling TikTok in terms of the source code is a Siamese twin operation. It's basically impossible.
AI conference next week, NVIDIA at the epicenter of that. Let's get to this new price target, $1,000. What are you expecting from Jensen next week? What's the big deal? What are we looking for?
Look, I think it's all, this is really, I think it's a grand event for the godfather AI Jensen to talk about what we see in terms of AI demand, obviously H200, in terms of some of the other technology changes that we're going to see in this AI ecosystem, where you come away being like, they're going to continue to own this market. AMD, Lisa Su, and others will clearly benefit. But this is a grand entrance, and it's also a showcase. It's a Flex the Muscles event for Jensen, wearing his black leather jacket, showing that in the AI world right now, it's really, everyone else is.
But are you looking for concrete changes to guidance relative to what we've already heard in the last couple of weeks?
There could be some longer term, metrics that they give, but right now, the last thing that they want to do is start to give more and more financial targets. I think this is more about an event showcasing the technology, showing where AI is from a demand perspective. But look, we believe it's a 1995 moment. This AI revolution, this party, it's getting the popcorn out. It's 10 p.m. in a party that goes till 4:30 a.m.
Let's talk about the popcorn after this particular conference that I think is actually really important, not just for sort of a signal of what other products they have coming out, but what industries can adapt most quickly to this 1995 moment. What are you looking for in terms of the types of technology and where they're geared to understand the efficiency and the potential areas that are going to benefit next?
It's all about use cases. Because really right now, it started with Jensen NVIDIA, it goes to Microsoft, and now it's the software piece. When you look at like the massive AI Palantir, you look at names like MongoDB, Snowflake, Salesforce.com, ServiceNow, this is now starting for the software sector, that AI momentum, which is why I believe, and we've talked about it, despite macro and a lot of other issues, this tech bull market continues to, I believe, go higher because of numbers, but it's going to be software-led. And I think that's what you're going to see. It starts on that first derivative, but now it's about second, third, fourth derivatives of this 1995 moment.
Formula One. I promise you some time.
Sure.
You converted. What changed you?
Look, I mean, the Netflix show on this 3-week trip, I watch almost obsessively in terms of the F1. I was not a fan. I've actually become a super fan. And so to me now it's trying to pick my team, whether it's McLaren.
Yeah.
But I don't want to just go down the typical central casting, be a Red Bull or Ferrari fan.
But you cover Tesla. You should be into Formula E.
That is true. And look, this is, I mean, it started with Faro, and now it's opened my mind to something that's really changed in terms of
You're going
F1.
to Miami, aren't you? That's what this is about.
I think I will be in the 305 for that.
I have no doubt. Dan, it's good to see you. Dan Ives, thank you, sir. Appreciate your time. It's thoughtful stuff. Dan Ives there of Wedbush, Miami, then I think a bit of Vegas later this year.
On a plane for long enough and binge watch a show, and that's all I can say. All of a sudden, it can really change desires.
Converted to Formula One. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Herkes. Hey, Yahara.
Hi, John. Bitcoin is retreating from its latest record high amid an intensifying debate about whether the bull run in cryptocurrencies has reached a bubble. It reached an all-time high of almost $74,000 earlier this week. Bitcoin and a gauge of the top 100 tokens, comprising the likes of Ether, BNB, and Solana, are up about 60% so far this year. Japan's workers are set for big pay increases after members of Japan's largest union group secured the biggest wage hikes in 3 decades. A combination of bumper profits along with a labor shortage, ongoing inflation, and government pressure helped convince boardroom executives they needed to raise pay by more than in past years. The result may be strong enough to nudge the BOJ on Tuesday toward ending the world's last negative rate. And Hamas has proposed what it's calling a comprehensive ceasefire deal in a bid to move forward talks with Israel. Reuters reporting the plan would see the freeing of Israeli women, children, elderly, and ill hostages. This in exchange for the release of up to 1,000 Palestinian prisoners. Israeli Prime Minister Benjamin Netanyahu says the militant group is still making unrealistic demands. The country's war cabinet is expected to discuss this matter today. That's your Bloomberg Brief. John?
Yahara, thank you. I think you're a McLaren kind of guy. Orange suits, you know?
I do.
Works. A Lando kind of dude.
I'm actually a big fan of his, so I could also be going down that direction too.
This works. Dressed in orange.
Yeah.
Miami.
Miami, and then Vegas. Next thing you know, will be Abu Dhabi.
We might do this together. Let's talk.
I'm ready. I'm waiting for the phone call.
Let's talk. Up next on this program, data pushing back rate cut bets.
We need to step back and we need to say, okay, we all look at this data today and what does this mean for the Fed next week? What does this mean for the Fed in May? You know, the Fed doesn't, at this point, it doesn't really know either.
Just for the record, I'm not going to wear orange, all right? Maybe a bit of Ferrari red or
orange
something
is the
like
new black.
that.
Yeah, but orange. But I'll be wearing orange, and you'll be wearing, you know,
Slim red tie,
Ferrari.
something like that.
Yeah.
Just a nod to Ferrari, sure. That's next. That isn't next. The Fed and that stuff is up next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Equities on the S&P 500 positive here by 0.2%. A flavour of the bond market for you through the week and on the session. Through the week, yields higher off the back of pretty strong economic data on the inflation side of things. CPI, PPI, retail sales coming in weak. We'll talk about stagflation in just a moment. In the bond market, yields lower today by 2 basis points, 426.87. Under surveillance this morning, data pushing back rate cut bets.
I wouldn't expect huge changes from the statement next week or from what Chair Powell says in his press conference relative to what they've been saying recently. We need to step back and we need to say, okay, we all look at this data today and what does this mean for the Fed next week? What does this mean for the Fed in May? You know, the Fed doesn't, at this point, it doesn't really know either. It's taking these data in its entirety as they come in, and it'll make its decisions as we go forward.
It's the latest this morning. Treasury selling off after a hotter than expected inflation print, reinforcing bets that the Fed is in no rush to cut interest rates, while lower than expected retail sales, leaving Ian Lingen of BMO saying this: the pace of retail sales during Q1 hints of the spectre of stagflation, although it's only a couple of prints and insufficient to draw any broad-based conclusion. Ian Lingen joins us now for more. Ian, let's get into this. Is that what we're starting to smell, the scent of stagflation this year?
I think that there's a non-zero probability that we find ourselves in an environment where demand continues to slow more and more. Certain aspects of inflation prove stickier than the Fed wants to see. And then the big question is, how does the Fed respond to that? What do? I think they've done a very good job of laying the groundwork to cut, not ease. And we're far enough into the cycle that they can justify that.
So if the dual mandate goes into conflict, you think they can still cut interest rates later this year?
Precisely.
Okay, so here's the question for the markets. The markets believes now that this Federal Reserve has established a more asymmetric approach to monetary policy, that if strong growth comes through, they don't have to hike, but if growth weakens, they can cut. Does it temper their ability to respond to adverse shocks if inflation remains sticky? You're saying they can still cut. I want to understand by how much. Are we talking about 1 or 2 versus, say, 5+?
You know, it's interesting because I think it really comes down to the composition of inflation and where the stickiness comes in. If it ends up being on the supercore measure, which is highly correlated with wages, that's a problem for the Fed. If it's housing, if it's OER, if it's rent, that's a residual from what happened a year and a half ago. And if that ends up being the case, then they can easily justify moving back closer to neutral if the situation warrants it. And what warrants it? It certainly isn't a flat GDP print. It would have to be well into negative territory.
Which raises this question, what is neutral? And I keep going to Elsa Linios and this idea that she was saying maybe neutral, in their view, is actually north of 4%. And that's what we're looking at, this sort of rolling ball of cash that's shifting into different areas and causing inflation to surge in different places that will keep inflationary pressures higher than they have been traditionally. Can you get on board with that?
I'm very much on board with the notion that neutral policy rates are a moving target, and it's not a single number that will hold indefinitely over time. I think that the Fed would probably agree that because of a lot of the dislocations that occurred during the pandemic, that our star was higher over the course of the last couple of years. The bigger question becomes, what is it like at the moment? Are we truly in restrictive territory? The combination of the balance sheet rundown and the fact that as year over year core inflation numbers start to decline, real policy rates will increase, really puts the Fed in a unique situation, and one that I certainly don't envy.
Well, what do you think? I mean, do you think that it's restrictive based on the evidence that inflation isn't really getting tamped down as much as people expect? And sure, we got one weaker than expected retail sales number, but you look at the earnings and companies are still doing all right.
So I would say that it was clearly restrictive during the second half of last year, which is why we saw the progress made on the inflation front. But the equity market doesn't believe that it's restrictive, and that's actually really problematic for the Fed since overall financial conditions are much easier than Powell would want them to be. And that feedback loop, to a large extent, is why I believe that there is some stickiness in the inflation complex at the moment.
I've got 2 questions. You've kind of alluded to the fact that you think he cares about equity markets, but he barely talks about financial conditions. When we raise the fact that equities are close to all-time highs and credit spreads are super tight, get people come on this program and say that's not that important to Chairman Powell anymore. Why do you think it is important?
I think that he's very strategic in the way that he chooses to emphasize the relevance of financial conditions. When they were tighter at the end of last year, it was very important because it was consistent with the messaging that he was putting forward, which is we're nearing the point where we're going to start cutting rates. If the Fed starts to reintroduce the conversation about financial conditions, that's hawkish in this environment. It's not dovish, and that would suggest that while the market seems content to price in a June rate cut at this moment, maybe the real departure point for normalization is July or later.
$20 trillion call for you now, Treasury market. What do I do with the long end? You've told me what you think is going to happen with the Federal Reserve to some extent, what that could mean for the front end of the curve. What do I do with a 10-year? What does that look like in the world that we're starting to sense is developing in 2024?
So I would say that we are in a period where we might see upward pressure continue to develop in the longer end of the curve, but 10-year yields aren't going back to 5%, and eventually we will find ourselves in a situation where inflation does start to moderate, and that means break-evens will compress, and that means that 10-year yields above, let's call it, 435 or 450 start to look attractive, but we're not there yet.
Which is really the reason why I was going to El Salinos' call. And people might say, R-star, neutral rate, my eyes glaze over, I don't care. But the idea here is that if the overnight rate is more than 4%, it doesn't make sense for 10-year treasuries to be trading at 4.27% currently. They would be trading at a much higher rate. So at what point does this market sniff that out? Since right now, there is none of that being priced in.
I would say that logic holds very well for the 2-year sector, and the operative issue is whether or not the Fed ever chooses to review the 2% inflation target. Because even if R-star is higher, if the Fed is going to get us back to 2%, that just means they have to risk greater demand destruction to get us there. And so, like I said, I'm very, very on board with bearish in the front end of the curve. Really hard to justify 10-year yields at 5%, even if R-star is 100 basis points higher.
To put a bow on it, are you basically saying the biggest risk case for next week is for Fed Chair Jay Powell to come out and say, I care about equities?
I would say the biggest risk for next week is that we all look at the 2024 dot, and it says 50, not 75 basis points worth of rate cuts, and that's what triggers a more dramatic bear steepening.
Andrew Honhorst of Citi just published on that. He said 75 basis points. The median dot will still imply 75 basis points. Can we have your base case? Is it 50 or 75 next week?
Base case is 50. Excuse me, base case is 75, but there is a real risk of 50.
Interesting. Ian, thank you, sir. Really thoughtful stuff. Ian Lincoln there of BMO. And what's developing in the economic data, Lisa, and how this Fed's going to respond to it later this year?
Given the fact that you've got both, you've got a little bit of everything, which is the reason why Andrew Hollenhorst actually has been talking about the weakness, allowing the Fed to cut more, and even at a time where there is this inflationary pressure. Tough moment, really tough moment.
Oh, big time. Getting closer to 430 as well on a US 10-year. Yields have been creeping higher throughout this week on both the front end and the long end. I think on the long end, we're higher by something like 20 basis points on the week from around 4.1%, getting close to 430 at about 427 right now. Coming up in the next hour, the third hour of Bloomberg Surveillance just around the corner. We'll catch up with Sam Stovall of CFRA, Kathy Bosch-Jancic of Nationwide, Bloomberg's Will Kennedy, and Mark Gurman are going to join us as well. We'll talk about the commodity market and what's developing with Apple. There is so much developing in the commodity market. Copper through 9K, gold, all-time highs. Got to talk about oil, close to the highs of the year. Live from New York, this is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.